Hello everyone, a very good evening. Please give me a quick confirmation. The audio and video is fine. Good evening everyone. So like I told you, today we are starting with the marathon. We'll be doing the marathon in two parts. Part 1 is today, part 2 will be tomorrow, same time. And our focus will be on practicing as many questions as possible along with the theory. Before we start with the questions, here we are going to cover our module E first because it is important from numerical point of view, and we'll also be covering our module A. All right. So once you're here, please mark your presence and let me know. I hope everyone has joined. Okay, so let us start. Right. So, Module E, which is the additional reading material on home loans, there are four units that we need to cover: the lender's appraisal procedure, housing finance and tax planning, mortgage advice, and valuation of real property. All right, we are starting with the first unit, which is Unit 27. Okay, loan origination. What is loan origination? When the customer approaches the bank with an application, they want to take a loan. It can be any form of loan. It starts from there. The process of loan origination, it starts from there, and then there are three phases. And this process will go on till the final disbursement is done, right? So the three phases are information acquisition, credit appraisal and sanction, and third is disbursement. These are the three stages and three phases of the loan origination. Now, the process of information acquisition, we need to collect all the correct information about the customer to determine their repayment capacity. So information related to their demographics, employment, financial details, it is a must for the banks. Also, to minimize the risk, the credit history should be checked so that the customer is not a fraud or a blacklisted person with any other bank or financial institution. Also, the information which is provided by the customer, we need to cross check it to make sure that it is correct and authentic. So for that, banks take the help of external agencies, the CICs. We have studied how the credit information works, right? The credit information report. Now bank may request even co-borrowers or guarantors to support the loan. All of this is to make sure that the customer doesn't default, right? So the banks, they collect fees for processing, for documentation, administration. Second phase would be credit appraisal, right? Credit appraisal would mean scrutinizing the information provided, right? We will make sure that the information provided by the customer is correct. By cross checking the information, we will also check the credit history. And finally, the third step will be disbursement. How do we disburse the loan? First, we will determine the amount to be sanctioned, and then we will disburse it in stages. If it is to purchase a particular asset, or if it is a home loan to purchase a ready-made house, then upfront disbursement will be done. Otherwise, if it is under construction, so in stages, and it can be done either through a check, or the amount can be transferred to the customer account, or if it is to buy a particular good, then directly to the supplier, right? The amortization schedule is prepared for the customer. Now, when the bank takes the application form along with the documents, application form will collect the relevant information that the lender needs, whether or not the loan exposure is under the acceptable risk, and whether or not the customer is genuine. So, the various details of the land and building, if it is being kept as a security, as a mortgage, the existing source of income, and how much it is, the age of the customer to determine the repayment period, existing liability, if any. When we are determining the loan quantum, we studied, right, that the net take home pay should not be less than 40% of the gross green salary of the customer. In case of the high net worth, it can be up to 15%, right? So all of these things are done. Now this is important that you remember the documents. When the customer is availing a home loan, there are certain documents that need to be submitted along with the application form. Along with the duly completed application form, we need the passport size photograph, proof of identity, the OVD, PAN, Aadhaar card, proof of residence, the proof of business, if they are a non-salaried individual, and if they are salaried, then their salary certificate, form number 16. Statement of bank account will also work as a proof. Letter of allotment, RERA approval is very important. Bank is not going to finance those construction or house which is not RERA approved. Otherwise, it will come under the illegal colony. Estimation or valuation report, because we need to determine the margin, the interest rate, the quantum of loan. So, approved valuers should do the valuation from the various methods, the statistical analysis method, belting method, rent capitalization method. And then, if it is an agricultural land, copy of the relative order. Now, when the customer is keeping their property, the immovable property as security, we need to make sure that the customer has a clear, absolute, marketable title on the land. Marketable means if the customer defaults, the bank should be able to sell the property. So, for that, we will take the sale deed or the agreement of sale. If it is an inherited property, so the parent documents, the non-encumbrance certificate that already the property has not been kept on security with another bank, the search report, possession certificate, latest revenue tax receipt to make sure that all the taxes have been duly paid, NOC and RERA approval. Obtention of the legal opinion of lawyers is important. The legal opinion, the bank should be convinced that the applicant holds a clear, absolute title. Valuation of the property needs to be done to determine the quantum of loan, right? If the application is made for a loan of, let's say, 50 lakh rupees, and the property which is kept as mortgage, its value is not equal to that, then it will be a problem for the bank. So before accepting the application, banks will do the valuation. They will ensure that the construction has been approved, the taxes have been paid, age of the building, the future life of the building, and RERA approval if applicable. Now, there's also the option of receiving an application through the agent. Let's say there's an Indian citizen, they're living abroad, but they want to purchase a house in India. For that, they want to take a loan. They can execute the documents by giving a suitable power of attorney. Now, they are going to act as agent, right? So, particularly for the non resident Indian who is not available in the station, power of attorney is given to another person. So they can act on behalf of the NRI Indian, right? So they will approach the bank, fill up the application, they will provide the mortgage documents. Now, before this, the bank need to make sure that they have the correct power of attorney. They actually have the power to execute these documents. There are types of power of attorney: a general power of attorney, a specific power of attorney, a universal power of attorney. Power of attorney for a specific act. Let's say only to fill up the application form of loan. It is a special power of attorney for a specific act, right? General power of attorney would mean more than one act, not only the application but also executing the mortgage documents. Then it is known as a general power of attorney. Universal power of attorney would mean that everything. This agent can do each and everything that the principal could do, right? And the power of attorney can also be executed in favor of more than one person. This power of attorney is irrevocable. This means that the agent is acting on behalf of the principal. All the acts that are done by the agent are actually acts of the principal itself, right? So they will continue to sign contracts, they will continue to enter into any contract or agreement unless it is expressly revoked or determined by the death of either of the parties, agent or the principal. So it is a continuous one. If the power of attorney is executed in a foreign country, it should be stamped within 3 months of it being received in India. Otherwise, now it will not be applicable. All right. So if the power of attorney, the documents are signed outside of India, within 3 months of it being received in India by the banks, it should get stamped. All right. These are the theoretical parts. So we are going through it. If you have any doubts, if you want me to repeat the topic, please let me know. Now, power of attorney for creation of mortgage. It is accepted only in specific or special circumstances. Only if the principal is actually not available here in India, or they are actually not able to sign the documents themselves. So it should be verified by the bank as to the necessity of a power of attorney transaction. If both the principal and the agent are residing in the same place, then what is the requirement of power of attorney? The bank will reject such a request. Bank will not accept this request in case of property, in case of the principal and the agent, if both of them are present here, right? So the banks, they will make sure that it is absolutely necessary. Only then the power of attorney, they make the application on behalf of their principal, right? There should be specific power or authorization to provide the mortgage documents. If the power of attorney does not have the power to create the mortgage, then it will not be a valid agreement or a contract. The schedule of the property should be fully described, the survey number, street door, locality, everything. And it is irrevocable. Once a principal gives the power to some other person, to their agent, to act on their behalf, whatever agreements, contracts are signed, whatever liability is incurred by the agent is actually the liability of the principal, and it gets automatically cancelled on the death of the principal. Okay. Then appraisal of the loan request. We have already seen how the eligibility is to be determined, the eligible loan amount, the eligibility of the person, the applicant. So various information along with the home housing loan application, appraisal form, term loan agreement, guarantee agreement, arrangement letter. You can just go through it. The type of mortgage being created. If it is a simple mortgage, then just the written document is there. If it is an equitable mortgage, we also need the original title deeds. The original title deeds have to be submitted. What is the mortgage deed? It is the contract, the instrument through which the contract is signed. Mortgager is the borrower, mortgagee is the lender. Eligibility. How do we determine the eligibility of the applicant, the customer? They should be in the preferred age group only, right? We determine that if it is a salaried person, then before their retirement, 60 years of age, the repayment should be complete. If they are a non-salaried person, they have their own business, then 65 years. This also depends upon the internal policy of the bank. Some banks, they may prefer a certain age group higher than this age as well, others might not. Then the minimum salary or income level. Does the borrower, they have a regular source of income or not? And what is their source of income? It should not be illegal. Score in the credit information report should be more than 700 at least. The areas and localities where the home loan will be given, and the negative list. Sometimes some borrowers are blacklisted by the banks or financial institutions because they had defaulted on their previous loan, or there were delays. They had willfully defaulted. So the banks should have a risk asset acceptance criteria. When the borrower fulfills this criteria, only then the loan should be sanctioned or the application should be taken further. Interest rate, again, fixed, floating, both can be offered. It depends upon the type of loan, it depends upon the customer. Insurance, insurance is to be taken in case of a house or flat. Moratorium, this statement we have read so many times. 18 months after the first disbursement of the loan or 2 months after the completion. Again, if we are purchasing the house, a ready-made house is to be purchased, then maximum holiday period of 3 months will be given. Otherwise, if it is for construction, 18 months can be given as the moratorium, as the holiday period. EMI, how do we determine the EMI? The equated monthly installment. Interest will be payable over the period of the loan at reducing balance to arrive at the total payable amount. Now, during the moratorium period or when the full disbursement is not made, the full principal amount is not taken to calculate the EMI. What do we take? We calculate the pre-EMI interest, right? It commences after 1 month of the full disbursement, right? EMI only after full disbursement is collected. Pre-EMI interest until final disbursement, the amount, the portion of the loan that has been given to the borrower, only on that portion they are required to pay the interest, right? So the borrower pays interest on the portion of the loan in installments. For example, the home loan sanction to Mr. Raju is rupees 10 lakh at the interest of 10% per annum. But right now, in the first phase of construction, the bank has only disbursed rupees 2 lakh. So they'll be required to pay interest not on 10 lakh rupees, but on 2 lakh rupees. So this is how we calculate the pre-EMI interest. Simple interest per month. P into R into T. So 2 lakh it has been disbursed till now in the first phase, multiplied by 10%, converted into the numbers, and we are calculating the monthly, right? Time in the year, month. So it is 1667. All right. So all you need to remember is that pre-EMI is calculated only on the disbursed amount until the full disbursement is made. Then EMI reset can also be done in the floating rate interest home loan. The total dues will change when the rate of the interest is changed. Now, lender does not change the EMI amount, they change the number of installments. Because if the rate of interest increases and we ask the borrower to pay a higher EMI, the higher amount, it might not be possible for them. So we increase the number of installment if the interest rate increases, and we reduce it if the interest rate decreases, right? Depending upon the change in the total dues. Now, check-off facility is also provided. I am earning my salary in the bank account, right? I have taken a loan from the same bank. I can have this option that every month from my salary, certain amount towards my EMI will be deducted. This is known as the check-off facility. So there will be an irrevocable letter of authority from the borrower. So a specific amount of monthly installment from our salary or wages will be deducted, and it will be paid as dues to the lender, right? Now it is the responsibility of the employer to inform the lender if there's a change in the agreement of employment, retirement, resignation, discontinuance of service, or death. Also, clearance from the bank will be taken by the employer before settling the dues to the employee on transfer, resignation, or retirement. This can be done. The check-off facility can work through a bank account. If the salary is paid through a bank, an irrevocable standing instruction will be taken. The lender needs to keep him informed of the changes in the employment situation. Right? This is the check-off facility. Now we come to the most important part of this unit, which is mortgage. When we are talking about home loans, the security is created on immovable property, that is known as mortgage. Basic things, right? Basic things. Mortgager is the borrower who is the owner of the property. Mortgagee is the lender, in our case, the bank or the financial institution who is given the loan. Mortgage deed is the contract signed, and mortgage money will include both the principal and the interest. So, what is mortgage? When the property, the immovable property, land, house, building, is kept as a security with the bank, it creates a specific interest on the property, right? Not a complete interest, a specific interest. If the value of the property is 1 crore, but the loan taken by the mortgager is 60 lakh, so only this 60 lakh plus the rate of interest, only this much amount will be the interest of the mortgagee, of the lender. Okay, so through the mortgage, which is defined, you need to remember this section 58A of Transfer of Property Act 1882. A transfer of an interest in the specific immovable property. Why? For securing the purpose of security for the payment of money advanced in an existing or a future debit or the performance of an engagement. Right? Now, under the Transfer of Property Act, if the borrower defaulted, if the borrower did not pay back the loan amount, then the bank had the right to sell the property, recover their loans, but they had to do it only with the permission of the court. They had to approach the court, take the court decree, and without intervention of court, it was not possible. Right? Now, with the Surface Act, what happened? Banks, they have the right to sell the property, attachment of the property, sale of the property, taking possession of the property without the intervention of the court. Okay, simply we will send a notice to the borrower that within 60 days you need to repay the whole amount, otherwise we are going to sell your property. Right? Now this is the whole concept of mortgage. You need to remember it is a transfer of an interest in specific immovable property. Now, there are mainly two types of mortgages which are given in your syllabus. We have a simple registered mortgage and an equitable mortgage. Simple registered mortgage. I want to live in the house which I'm keeping as mortgage, which I'm keeping as security with the bank. Then which instrument I can execute? I can execute the simple registered mortgage. So here, without delivering possession of the property, I will bind myself personally to pay the mortgage money. And in the event, if I fail to pay the mortgage money, the principal and the interest, the mortgagee will have the right to cause the mortgage property to be sold. Let's say the value of the property after selling comes out to be 90 lakh, right? The principal and the interest which became NPA was only rupees 75 lakh. So the remaining 15 lakh will be returned back to the borrower. This is a case study that can be asked by the institute. Okay, I will apply the proceed. The lender will apply the proceeds only to the extent of the NPA, whatever amount is unpaid. Remaining, if anything is left, it will be returned to the borrower. Let's say the value of the property is 90 lakh, but the loan that was taken was of rupees 1 crore. There's a shortfall of rupees 10 lakh. This shortfall, the lender has the right to still recover this shortfall from the borrower. Okay, this is the meaning of a simple registered mortgage. So I can continue to have the physical possession. I need not give the physical possession to the mortgagee, the lender. I'm just transferring the specific interest. Okay, here if the mortgagee is selling the property, they cannot do it without the intervention of the court. They can sell the property only with the intervention of the court. So they will apply to the court, they will obtain the court decree. The court has its own receiver, and accordingly, the property will be sold. The bank will be paid off their dues, right? The registered mortgage involves preparation of a mortgage deed. It should be witnessed by two witnesses. Ad valorem stamp duty should be paid. So it is a costly proposition, right? Then we have the second type of mortgage, which is deposit of title deeds. Another important point that you need to remember in the registered mortgage. Let's say the property, I did not deliver the possession to the bank. I kept it with me, but I'm not living in it. I have given it out on rent. Some tenants are living. Will the bank have any right over the rent or property coming out of the mortgage property? No. Any rent or profit which is being generated from the mortgage property, the bank cannot recover their loan from it. Right? This is another important feature of the simple mortgage. Bank has no right over the rent or profit of the mortgage property. Coming to the deposit of title deeds or equitable mortgage. Let's say I'm giving you a scenario. I'm living in Lucknow, right? But my job requirement was that I need to get transferred to Bombay. Now I want to buy a flat in Bombay. What can I do? I'm taking a loan in Bombay. I can keep this property, which is in Lucknow, as mortgage. Now, the bank will not have any monitoring or supervision of this property because it is situated far away. What they will do? They will ask me to submit the original title deeds of this property in Lucknow. All right. So basically, what the equitable mortgage says that in the districts notified, the towns notified by the state government, the title deeds will be submitted and the property can be located anywhere in India. Okay, so when a person in any of the notified towns, Kolkata, Chennai, Bombay, any other town notified by the state government, delivers to the creditor the title of the immovable property, documents of title of the immovable property to create a security thereon. Then it is known as the mortgage by deposit of title deeds. Please remember, there's no restriction on the location of the property, the house, land, building. It can be anywhere in India. The mortgage deed is created where in the notified towns, not only Kolkata, Chennai, or Mumbai. These are given as per the old provisions, but the state government notifies these towns, right? So, what are the requirements of the equitable mortgage? There must be a debt, either existing or future. There must be a deposit of document of title. Are copies accepted by the bank? No, because there are situations that to one bank, one copy is given, to another bank, another copy is given. The borrower can have as many certified copies as they want, right? So there must be a deposit of the original documents of title, and the deposit must be made in one of the notified town by the mortgager or his agent. It will be for the intent to create a security, and the letter of intent should be obtained. Okay, so these are the features, requisites of the equitable mortgage. Now, you might say that equitable mortgage, the property is located far away and the bank has no right over it, so it will have lower priority. No, the mortgagee in the equitable mortgage have equal rights, same rights as are there in the registered mortgage. So let's say in 2024, an equitable mortgage was created by a person on a property. Then in 2025, a registered mortgage, a simple mortgage was created. Now, in no manner, this equitable mortgage will be treated as inferior, right? So, an equitable mortgage will have priority over the subsequent registered mortgages because the original title deeds were already taken by the bank. If the bank parts away with the original title deeds, they are going to lose the mortgage. So it is important that they keep the title deeds with themselves, right? Retaining the title deeds is important. Giving the title deeds for obtaining a legal valuation or legal opinion of the lawyer, that is not the meaning of parting away or giving up away the documents, right? So, if the mortgagee parts away for examination by the solicitors, for obtaining a second mortgage, or to getting a lawyer's opinion, then they will still continue to have the right over the property. But if they lose the title deeds or if they give the title deed back to the mortgager without getting a trust receipt, then they will lose the mortgage, they will lose their right over the property. Now, what will happen on default? What are the remedies which are available in a equitable mortgage and a registered mortgage? Let us compare them. Is there a transfer of possession? No. Neither in a simple mortgage nor in an equitable mortgage. There is no transfer of possession. Okay. Then what rights do the mortgagee have in the case of default in the payment of the loan? Can they sue for personal liability? Yes. They can sell the property only after obtaining the court decree as per the Transfer of Property Act. right? So can they sue for personal liability? Yes. Personal liability means if there is any shortfall, then the borrower will have to cover it. Okay. Can they sue for the sale of the mortgage property? Yes. They have to apply to the court. With the court's order, they can sell the mortgage property. Rest, any rights are not given either under the simple mortgage or equitable mortgage. Only two rights are there. They can sue for personal liability and they can sue for the sale of mortgage property. They cannot sue for foreclosure. Foreclosure means denying the right to the borrower to take back the property. Foreclosure means now they are taking physical possession of the property. Right of foreclosure is available under other types of mortgages, like there's a usufructuary mortgage, not in your syllabus, but in simple mortgage or equitable mortgage, right to sue for foreclosure is not there. Can they sell the property without court permission? No, they cannot do it. After the SARFAESI Act, they have the power, but as per the Transfer of Property Act, they are not allowed. Can they enjoy income out of the mortgage property? Any rent or profit? I already told you no. Rent or profit again is given under the usufructuary mortgage. Can they appoint a receiver with the court's permission? No. The court will appoint the receiver themselves. There's a receiver attached to the court. The court will do the proceeding. Bank has no right other than suing for personal liability or for the sale of mortgaged property. When the borrower defaults, they have the right only to sell the property. They cannot take the physical possession. And everything has to be done with the court's permission only. Right? So, what is the right of foreclosure? Now, the only term is given mortgage by conditional sale. What is the conditional sale? Ostensibly, the property is sold. Conditionally, the property is sold by the mortgager to the mortgagee. Conditionally means if the borrower defaults, then the sale will become absolute. If the borrower does not default and repays the loan, then the property will be returned back to the mortgager. Right? This is the conditional sale, which is not given in your syllabus in detail. The right of foreclosure is available in the conditional sale. Right? The mortgagee has the right to sue for the decree, to debar the mortgager to get back the mortgage property. This right of foreclosure is not given in our simple mortgage and equitable mortgage. Okay, priority of charge. Now, where a mortgager creates more than one equitable mortgage over the same property, the institution in whose favor the mortgage is created first has the priority. So, equitable mortgage. Mr. X, they took their title deeds to Bank ABC and they submitted a copy of the title deeds to Bank ABC. They got the equitable mortgage. They approached afterwards, let's say in 2021 to Bank ABC, in 2023 to Bank XYZ, and then they submitted another copy. So in this scenario, Bank ABC will have priority because in their favor the mortgage has been created first. These issues were there before the SARFAESI Act. Now only the secured creditor who gets their charge registered will have priority, not only over the unsecured creditors, but over the government dues, taxes, shareholders, preference shareholders, everyone, right? Then let's say the mortgager has created separate registered mortgages over the same property in the favor of two or more financing institutions. Then the priority will be determined with the reference to the date of execution of the deeds, duly registered within 4 months of execution. Now, earlier, before the SARFAESI Act, the charges were to be registered with the ROC, right? Creation of a simple mortgage is not important. Registration of charge is important. So let's say in 2021, on the same property, Bank ABC got the charge created. They gave the loan to the borrower. Then in 2022, Bank XYZ gave loan to the same borrower on the same property. But Bank ABC did not get the charge registered, and Bank XYZ got the charge registered with ROC. In this scenario, although Bank ABC gave the loan first, but in the case of default, selling of the property, the proceeds will be used to pay off the debts of Bank XYZ first because their documents were executed first. They were registered first, right? Then, if the mortgager gives the same property in equitable mortgage to one financing institution and later on they get a registered mortgage with another financing institution, then what will happen? Equitable mortgage will have priority. Equitable mortgage in no way gives inferior rights compared to the registered mortgage. The equitable mortgage is already considered registered, right? It is considered that the original title deeds have been given. How can any other bank give a loan without checking the original title deeds? It is their problem. And whenever a charge is created with the ROC or with SARSAI, it is deemed to be a public notice. It is deemed to be that each and every person knows that this property has been kept as a security with the financial institution. So any subsequent financial institution should check the encumbrance. Then, before giving out the loan, certain things need to be checked by the bank, like the tenure of the land should be checked, valuation of the property should be done. Tenure means how many, what is the holding, the type of holding that the borrower has over the land, whether it is a freehold, leasehold, or state owned land. Freehold means that the borrower has absolute ownership over the land. They are the only sole owner. They are the only person liable to pay the taxes to the government, local authorities, whatever. Leasehold means that they have taken the house on lease, or the land on lease, right? So the land is held for the period on terms and conditions. Even a person who has taken on the lease can create a loan. State owned land means it is a government, central or the state government occupied land, and they have the occupancy. Banks will reject the loan. Valuation of the land should be done by personal inspection, comparison of the recent sales of the similar properties, acquiries from the property. Let's say there's a house in a particular area which is to be kept as mortgage. The main purpose of security is that if the borrower defaults, then we will sell the property and recover our dues. This is the main purpose of creating a security. To be able to pay off the dues, the property should be valued. So what can we do? We can compare this property with the similar property in the locality. We can ask the previous, in the past, let's say recently someone has sold a similar property in the similar area, right? And we should take the help of approved valuers who have knowledge and experience. Okay? So allowance must be made that the price realized under the forced sale is often falling short of the real worth of the property. This will lead to loss for the bank. To avoid such a scenario, proper valuation should be done. Title of the property, whenever equitable mortgage is being created, copies of title deeds are not document of title. Only if the original has been lost, it has been destroyed. In exceptional cases, the bank will accept certified copy. Otherwise, in case of equitable mortgage, the bank will only accept the original title deeds. Very important. Okay. The certified copies, if accepted by the bank, in exceptional cases, should be issued by the registrar of assurances, only with the proof that the originals have been destroyed or lost. If the original exists, then the bank will not accept the certified copy of the title deeds, right? Then the bank will check that all the land revenue and municipal taxes have been paid. All the taxes which are accruing or falling due should be paid in the future. No income tax should be outstanding. Otherwise, later on, the government or the municipal authorities can come and claim their right over the property. Now, registration of documents. Before the SARFAESI Act, under the SARFAESI Act, the SARSAI has been created, right? The Central Registry for registration, modification, satisfaction of charges. Before the SARSAI, in each state, the relevant Stamp Act was working, right? The documents relating to the transactions have to be registered. Even a gift and the lease of movable immovable property has to be registered. Wherever the right is created on the immovable property more than 100 rupees, it had to be registered as per the Transfer of Property Act. What is immovable property? Land, building, anything which is attached to the land. It cannot be separated to the land, right? If anything is currently attached but it can be separated, like growing crops or grass, it is not immovable property. Anything that can be severed or separated from the land is not an immovable property. Something which is permanently attached will be immovable property. Okay, so all the documents wherever registration is compulsory will be registered with the sub registrar within the district wherever the property is located, right? Original document printed on one side will be acceptable. Presence of two witnesses and payment of the appropriate registration fees is important. And once this whole procedure is completed, a distinct serial number is issued, right? Fees was to be paid. The state government, under their own Stamp Duty Act, determines the fees to be paid for the registration of the document, either on the premium or the sum payable. All of these things have been removed. All of these things have been removed with the SARSAI. Now, earlier, as per the Registration Act, any document other than a will has to be presented for registration within 4 months from the date of execution. Execution means signing of the agreement. Signing. When an agreement is created, it is a proposal, right? It is a proposal. Once both the parties sign to the same terms and conditions, then it will become a contract. When it becomes a contract, this means it is execution. All right. So execution, from the date of execution within 4 months, it has to be registered. If there's any delay, additional fees will be paid. Deed of confirmation should be obtained from the government. All of these things are there, right? Now, SARSAI, important part. The Central Registry of Securitization, Asset Reconstruction and Security Interest of India, SARSAI. It has been set up, it became functional with effect from 2011 and under the SARFAESI Act. So now it is the central authority. Any charge of creation of a security, modification, satisfaction, even asset reconstruction or securitization has to be registered with the SARSAI only, right? The charge has to be registered with the SARSAI. The SARSAI is going to maintain a register. Whenever anything is entered by SARSAI in the register, now it becomes a public notice, deemed to be a public notice. Everyone has the notice of this asset reconstruction, securitization, or creation of security interest. Transactions that are movable, like hypothecation, intangible asset, can also be filed. Mortgages are compulsory. Apart from mortgages, other types of transactions can also be registered with the SARSAI. Then, when a security is taken, the lender is a secured creditor. Our bank is a secured creditor. When they get the charge registered, they will get priority. So a registered charge with the SARSAI always has priority over all the other unregistered or later registered charge. Now, as per the Registration Act, before SARSAI, within 4 months, the charge had to be registered. After SARSAI, registration has to be done within 30 days of creation of the charge, right? By paying the normal fee. Then, if there's a delay within 30 to 60 days, 60 to 120 days are allowed. Beyond 120 days, the charge cannot be registered. And now our creditor will not get priority, right? So, maximum 120 days are given. And in these scenarios, some additional fees has to be paid. Okay, additional fee not exceeding 10 times of the amount of such fee. How the fee is to be paid? If the creditor does not get the charge registered within the stipulated time period, they're punishable with a fine up to rupees 5,000 per day. Now you need not remember these forms, it is just given as a reference to you. Okay, it is not important that you remember these forms. Particulars of creation or modification of security interest, form 1, submitting rupees 100. Satisfaction means the interest has been paid off, the principal has been paid off, form 2, and it is free. Particulars of securitization or reconstruction, form 3. Okay, like this the forms are there which the banks they need to fill up and submit to the SARSAI. Monitoring is important. Monitoring relates to the post sanction activities. Monitoring is proactive. Proactive means once the loan has been disbursed by the bank, they will make sure that the borrower is paying off all the EMIs, the principal and interest as per the determined schedule. If there is any aberrance, if there is any delay, they will contact the borrower, ask them what is the reason of such delay, right? Also, the banks will make sure that the loan that has been taken is being used for the specific purpose only. Diversion or siphoning off of funds is not being done, right? So it is the function of the credit administration department of the bank. If any part of documentation is incomplete, risk management does not sign off, the manager will have to seek waiver of procedure. Basically, they cannot use easy terms in the post sanction activities. They have to be very careful during the monitoring. Done. We are done with our unit 27, the lender's appraisal procedure. Till here, is everything clear? Everyone who's present here, now you can give me your confirmation. First stop, right? Is everything clear about the simple and the registered mortgage, the registration of charges with SARSAI, determination of priority? Everything is clear? I need a confirmation from you all. Please give me a confirmation. Everything is clear? Yes? All you need to do is just carefully listen. Carefully listen to whatever I'm telling you, and you will just remember it in your exam. You need not write anything down, and please don't use anything else right now, any other notes. Just listen to what I'm saying. Clear? Great. Now we are starting with the unit 28, which is the housing finance and tax planning. Very, very, very important unit. The section 24, section 80C, section 80EE. How the tax benefits can be claimed by the borrower. So, in respect, when they take a housing loan for the purchase or construction or repairs of a residential unit, they can avail the benefit of payment of interest as well as repayment of the principal, right? Whatever interest I pay on my home loan, I can claim it as a deduction as per the section 24. Whatever principal repayment I do on my home loan, I can claim as a deduction as per the section 80C. And if I am buying the house for the first time, then I can claim the deduction under section 80EE. So first you need to remember these heads. Interest 24, principal 80C, first time home buyer 80EE. Now we'll be studying the conditions that need to be fulfilled for availing these tax benefits. Okay. Under section 24B, I can claim the interest that I pay on my housing loan as a deduction from income from the property, salary, business or profession capital gains. Maximum up to a value of rupees 2 lakh. So the maximum deduction which is allowed under section 24B is rupees 2 lakh. There are certain conditions. The loan should be taken on or after 1st April 1999, and the purpose of the loan should be for the purchase of a ready-made house or flat, or the construction only of a residential property. If the loan is being taken for a commercial property, this section will not give you the benefit. Okay? Yes. So, and when we are taking the loan for the construction of the property, it should be completed within 5 years of raising the loan. Whenever you take the loan, within 5 years, the construction should get completed. A completion certificate should be issued. It will be submitted to the bank, right? And you can claim the deduction only from the financial year when the purchase or the construction is completed. The lender will issue a certificate at the end mentioning the interest and the principal, and the interest payment of the home loan can be taken for a self-occupied property. I can also claim the benefit if it is a not self-occupied property. I've given it out on rent to someone, right? It is not self-occupied, it is rented or deemed to be rented. Then there is no maximum limit for tax deduction. The taxpayer can take the deduction on the whole interest amount. Also, if the home loan is availed for the construction or the purchase of the house, then 2 lakh rupees is the deduction. If it is for the repair or renewal, then amount of 30,000 is allowed. Right? So, 3 points that we need to remember basically for section 24B till here. 2 lakh maximum for the construction or purchase of a residential property only. Self-occupied property, if it is not self-occupied, then there's no maximum limit. And repair or renewal, it is 30,000. Now, I told you that the construction should be completed within 5 years of raising the loan. If the construction is not completed, it will reverse the benefit. We will see how. So it is important to note that the tax deduction is deductible on a payable basis, on an accrual basis, and if the construction is not completed within a period of 5 years, then what will happen? The benefit will be reduced from 2 lakh to 30,000, right? From the end of the financial year in which the loan was taken. If any other, if in any year this 2 lakh benefit was there, interest will be paid by the customer. It will be treated as a capital gain. Okay. The deduction will be allowed in 5 equal installments starting from the year in which the house is purchased or the construction is completed. Pre-construction interest is also allowed to be claimed as a tax deducted. Okay. Then income from house property in the case of a self-occupied property will be zero if there is no interest on the housing loan, or it will be negative to the extent of the interest on housing loan, right? So if we are paying no interest on the housing loan, then we cannot claim the deduction, right? And the deduction cannot exceed either 2 lakh rupees or 30,000. 2 lakh means when it is for construction or purchase, 30,000 when it is for the repair of the house. Okay, so these are the features. Then I can also have the tax benefit on the home loan principal repayment. We had studied in our module D about the section 80C, right? The various schemes in which I can invest in to claim the deduction of 1.5 lakh under the section 80C. One of those areas is paying the home loan principal, right? So the maximum tax deduction is 1.5 lakh. 80C deduction is inclusive of it. So it can be availed for both self-occupied and let out property, maximum of rupees 1.5 lakh every year, which is taxable income of the assessee on the principal repayment. Now, ATC allows other deductions also, like the amount that I invest in my PPF account, or the tax saving fixed deposit, or premium I pay on my life insurance, the national saving certificate, senior citizen saving scheme, Sukanya Samriddhi Yojana. All of these are the various areas where I can invest and claim the deduction under section 80C. It is inclusive of all of these options. All right, it is inclusive. And the tax deduction is available on a payment basis. It does not depend on the year for which the payment has been made. When the payment has been made, deductions can be claimed. Stamp duty registration fee is also allowed. All of these highlighted points, they can be asked as question. The institute will give you the multiple selection, multiple statement type questions like which of the following are true about the tax benefits in respect of section 80C. So you need to remember, right? Tax deduction is available on a payment basis. Stamp duty and registration fee is also allowed. Deduction can be claimed whether the assessee has taken a loan or not. The section 80C can be claimed whether they have taken a home or not, right? This means if I'm making investment in the other areas, then also I can claim the benefit. Okay. Then there are certain conditions that have to be fulfilled so that I can claim the deduction on the principal repayment only if the construction is complete. Under construction property is not allowed for claiming the deduction. Then the repayment that I make during the year of construction, I cannot claim the deduction. Deduction is available, doesn't matter whether the property is self-occupied or it is let out, and this benefit can also be claimed for more than one house property. Let's say I purchased a house, I took a loan in 2021, I want to take another house in 2025. Both are allowed. Only for the first time home borrowers, such a condition does not exist. However, if I sell the house when the construction is completed or I acquire the house, if I sell it within a period of 5 years, then tax reversal will happen. If the house property for which the tax benefit was availed is sold within a period of 5 years from the end of the financial year in which the property had been given in the borrower's possession. So I got the property in my possession in 2021. The construction was completed, or I purchased the property and on which I had taken the loan. And I sell it in 2024. I sold it in 2024. What will happen? In this scenario, the tax benefit under ATC will not be eligible for claim in this financial year 2024. Also, for the year 2021, 2022, and 2023, whatever deductions I had claimed will be now deemed to be income of the year of 2024, and I will be liable to pay tax on the income. Right? So I acquired the property in 2021. I sold the property in 2024. For 2024, I cannot claim the deduction. Plus whatever I did claimed before that, I will have to pay tax on it. Right? So this is the reversal of tax benefit under section 80C. Then the third section which offers me benefits is the section 80EE, where the deduction for the first time home buyers is there. I am buying the house, I'm getting the house constructed for the first time. I do not own any other house anywhere. Then I can claim the deduction on the interest that I pay on the home loan. This is additional. I can claim 2 lakh rupees under section 24, plus I can claim 50,000 rupees under section 80C, right? Over and above the section 24. So the quantum of deduction is 50,000 and it is over and above the deduction of section 24 and section 80C. All right. So if I am a first time home buyer, this is an additional benefit that I get. Conditions necessary: the deduction will be availed only for the home loan sanctioned between the financial year 1st April to 31st March in the financial year. Value of the property should be less than 50 lakh and the loan should not exceed 35 lakh rupees. Amount of the claim deducted under this section will not be eligible to the claim under section 24 again. If I have claimed a deduction under section 80EE, I cannot claim it again under section 24. They are separate. Tax benefit can be claimed till the time of the repayment continues. Only applicable for the first house property. It can be either self-occupied or it can be a rented property. And in this scenario, no other house should be owned by you. If it is the first house that you are buying, then you can claim this additional 50,000 rupees over and above the section 24 and section 80C. Okay, the deductions can be claimed in this section only by the individual taxpayers on the properties purchased either singly or jointly. So let's say Mr. X and his wife Mrs. X. They bought the house together. They are in a joint ownership and they are paying the home loan interest in the joint ownership. Both of them are sharing the interest. Then both of them can separately claim the benefit under section 80EE. So it is available on a per person basis. Definitely it will give more benefits. So if you have purchased the property jointly with your spouse, both of you are paying the installments, then both of you can individually claim this deduction. And it is not necessary to reside in the property for which you want to claim this deduction. It can be a self-occupied property or it can be a property given out on rent. All right. So both the spouse can separately claim. Mr. X can claim 50,000 and Mrs. X can also claim 50,000 rupees. Rented accommodation is also eligible. If the property is rented out, then the amount of loan can be fully deductible. Now, this is the formula for gross annual value, not the formula, rather a concept. How do we determine the gross annual value of the property which is let out throughout the year, which is given out on rent throughout the year? We will compute the reasonable expected rent of the property. If I say that in the nearby, in my neighborhood, similar house is there which is given out on rent and monthly the tenants are paying 10,000 rupees. So using this value, I can calculate the reasonable expected rent of the property, compute the actual rent of the property. Let's say it is actually given out on rent and every month the owners are getting rupees 15,000 as rent, then that is the actual rent. How do we compute the gross annual value? It will be the higher of the amount. So let's say the reasonable expected rent was what? 10,000 multiplied by 12. The actual computed rent was 15,000 multiplied by 12. Higher of the two, obviously the second one will be the gross annual value. Okay, the gross annual value. Very simple. If the institute gives you such a question, it will be a 2-mark question, easy 2-mark question. So you just need to remember the reasonable expected rent, actual rent of the property, whichever of these two is higher will be the gross annual value. How do we calculate the reasonable expected rent? I can either see what is the municipal value of the property, the fair rent of the property, or if the property is covered under the Rent Control Act, then the rent cannot exceed more than that, whatever is stipulated. What is the meaning of municipal value? The municipal authorities, they collect taxes. For that purpose, they create a list. They make a periodic survey of all the buildings in their jurisdiction. From that list, I can check what is the municipal value. Right, fair rent would mean the expected rent. Similar property, my neighbor has also given out their house on rent. They are receiving rupees 10,000 every month, so I will expect that this is the rent that I am going to get on my house. That is the fair rent. And standard rent is as per the Rent Control Act. If the Rent Control Act stipulates that maximum 7,000 per month you can collect as rent from such property, then that is the maximum rent, right? So either we will determine the expected rent from the municipal value, fair rent, or the Rent Control Act, or if it is actually given out on rent, then we will calculate the actual rent of the property when the property is let out during the year. right? And the vacancy period will not be deducted. Let's say out of 12 months, for 1 month it was not given out on rent. Then we will not deduct that 1 month. We will multiply it by 12, right? Unutilized rent of the property means something which the owner could not recover from the tenant. That can be deducted, otherwise not, right? When can the unrealized rent be deducted from the actual rent? When the tenancy is bona fide, the defaulted tenant has fled. There's no way of finding out the tenant and recovering them, right? We cannot compel them to pay the rent. The defaulting tenant is not in occupation of any other property of the taxpayer, and the taxpayer has taken all the steps to recover the amount, but they are unable to get it from the tenant. In these scenarios, the unrealized rent will be deducted, otherwise not. Okay. Now, interest on the home loan for commercial property. Commercial property or loan taken for business or personal needs against the mortgage of the property can also be fully claimed, but now that will not be a income from the property. It will be income from rent business profession, and they will not be covered under the section 24 ATC or EE, right? Home loan, obviously, if the property is purchased jointly by the spouses, they are jointly paying the loan, they can independently claim the benefits. So the tax benefits get divided among the owners. It is more profitable for them. Each co-applicant can claim a maximum rebate of 1.5 lakh for the principal repayment under Section 80C, as well as 2 lakh rupees for interest payment just when they have bought the house jointly. It is in their joint name, and whatever rent, whatever interest they are paying, whatever part of the loan they are paying, accordingly they can have the benefit. So a joint home loan can give more tax benefits. So under all the sections 24, 80C and 80EE, if a joint home loan is taken, both of them are paying the loan, then what will happen? Both of them can individually claim the benefits. In case of NRI also, they can claim the benefit. NRIs, if they are a resident Indian, they can claim the benefit up to 1.5 lakh under Section 80C, 2 lakh under Section 24. Similarly, a non-resident Indian who repays the home loan is also eligible for the tax rebate. That is, they have purchased a house in India, they have taken a home loan from India, from some Indian bank, right? They have paid off the loan, they can also claim the benefit, but they are not aware of it, right? These are the features about the tax benefits in respect of housing loan. In case the salary earned abroad is the only source of income, then the NRI does not have an opportunity to claim the tax exemption because they're not paying tax in India. We have studied about the taxability, right? Resident Indian, resident, ordinarily resident, they are paying taxes to the Indian government on the income that they earn in India as well as abroad, their global income. Non-resident Indian pays only the tax on their Indian income, not on their global income. But if they are not earning any income in India, they are not paying any taxes to the government, why would they claim the deduction? Right? So if an NRI is earning their salary only abroad, they will not have the opportunity to claim the exemption. Right? Only when they earn an additional taxable income from India, then they are eligible to claim the tax exemption. Done. So we have completed our unit 28. Clear? I need your confirmation now. Each and everything about the three sections, the conditions to be fulfilled, the deductions that can be claimed, everything is clear? Yes, everything is clear. If you have any doubts, any queries, any questions, then you can ask. I need your confirmation, everyone. Now we have to start with our unit 29, which is mortgage advice. From this unit, numerical questions are asked, right? The time value of money, annuity due, ordinary annuity, these topics are there. Capital gains is again here. Reversal of tax benefit is available to section 80C or 24B both. If the construction is not complete, the tax benefit will not be given. 80E is possible to claim in one financial year. 80EE. Yes, yes. Okay. Reversal of tax benefit will be there if the construction is not completed within 5 years. True. 80EE deduction is available for the first time home buyer and the financial year it can be claimed. All right. Shall we start with the next unit now? Mortgage advice. Okay. Yes. What is the meaning of mortgage advice? I am a customer of a bank. I want to avail a loan. I approach the bank, right? Or I approach a professional to give me the best advice. Which type of loan should I take? Which property should I keep as mortgage? Which type of mortgage should I go for? Registered mortgage, equitable mortgage, or should I go for a conditional or usufructuary mortgage? This is known as mortgage advice when a professional is giving me advice. But such a profession does not exist in India. Like there is portfolio management, there's investment management, there's mutual fund. It is professional. SEBI registration is important. Mortgage advice profession is carried out without any regulation. Any person can come and claim that I am a professional in giving mortgage advice, and no one can stop them from entering the market. There is no entry barrier, there is no code of conduct or ethics which are stipulated by any regulation. Any person can enter the provision. Obviously, they can give wrong advice as well, right? In countries like US, proper mortgage advice profession exists. They are registered with the government. Only then they can provide these service, right? They're registered through chartering, licensing, auditing, examination. But in India, no such licensing exists. Okay, first point you need to remember, no regulation, any person can enter the profession and provide mortgage advice. They can do the business, they need not require any registration. Home information pack. What is the meaning of home information pack? Whenever the bank gives a loan, they give out the whole details about the property, the interest, how it is determined, the repayment schedule. These things are given by the bank. But about the property, it is not included in the information given by the banks in India. Again, it is there in countries like UK and US. They explain the concept of home information, home loan, the performance certificate, everything. Like if it is a four-bedroom property, then what all will be required? If it is a smaller property, what all will be required? For sellers, this will help them get better prices. For buyers, they can get the information free of charge about the properties they are buying. Again, in India, this does not exist. All right. The home condition report containing the information about the physical condition of the property, legal summary giving the legal aspects helpful to the buyers, the contents providing the information of the matters related to the property, not in India. Okay. Now we have the concept of time value of money, interest, and annuities. If, for example, I am investing 5,000 rupees in a asset, in a bond today, and it comes with a fixed maturity of 5 years. So, what will be the value of this investment at rupees, let's say 7% per annum after 5 years? If I am determining this value, it is known as compounding. Going from the present to the future, determining the future value is known as compounding, right? Compounding is used to determine the future value of present cash flow. If I invest 5,000 rupees today at 7% per annum, after 5 years, what will be the value of this investment? Similarly, if I'm taking a loan today of, let's say, rupees 10 lakh, after 10 years it has to be repaid. How much will I have to repay? That is also known as compounding. Going from the present to the future. Coming back from the future to the present is known as discounting, right? This 5,000 rupees that I'm investing today will give me after 5 years 10,000 rupees. So what is this value of 10,000 rupees today? Any investment that gives me rupees 10,000 in the future, what is its present value? Okay, so calculating the present value and calculating the future value, this is known as the time value of money. Going from the present to the future, it is known as compounding. Coming back from the future to the present is known as discounting. Discounting, a less value will be there, obviously. Compounding, a more value will be there. Now, there are three rules to determine the number of years. If I want to see in how many years, if I'm making an investment of 1,000 rupees at 6%, interest rate, in how many years will it become two times, or in how many years will it become three times, or in how many years it will become four times? To determine this, the concept of 72, 115 and 144 is used. Simply divide the rate of interest by the number. So divide the number by the rate of interest. So 72 divided by 6, the number of years in which this 1,000 rupees will become 2,000. 115 divided by 6, the number of years in which it will become 3,000. And 144 divided by 6 will give me the number of years in which this 1,000 rupees will become 4,000. All right. So it will help me determine the number of years before my money becomes almost double, triple, and four times. We divide the number 72, 115, 144 by the percentage rate that I'm paying on my debt or I'm earning on my investment. Right? So this is how we use the three rules. Very simple rules are there. We'll be doing the numerical questions. Very simple. Right? Now, how do we calculate the future value of money? How do we calculate the future value of money? The formula is used, which is future value is equal to present value multiplied by 1 plus r raised to power n. Let's say I need to calculate what will be the future value of investing 10,000 rupees today at a rate of interest of 5% for 5 years. Right? This is what I need to determine. First, what I will do, I will convert this 5%. Converting it will give me 0.05 raised to power 5. Right? I hope you remember how do we calculate it. Simply use your calculators to do it. You'll have to carry these basic calculators to your exam. So we will calculate what is given in this bracket first. So 1.05 raised to power 5. I will write down 1.05. I will write down 1.05. I will press the multiplication button once, and then I will press is equal to button four times. Whatever is given in n, minus 1 will be the number of times for which I'm going to press the equal to button. So 1, 2, 3 and 4. Okay, 1, 2, 3 and 4. So this is giving me somewhat 1.2762. If such a number is coming, I will simply write it as for the two digits. So 1.27 multiplied by 10,000 rupees, right? Simply multiply it by 10,000 rupees. I will get the future value 1,200, sorry, 12,762.8 rupees. Okay, this will be my future value. Simple formula is to be used. Present value multiplied by 1 plus r raised to power n. This is how we calculate the future value. What is the meaning of future value? 1 rupee, r is the rate of interest, n is the period. So if let's say 1 lakh rupees is invested for a period of 5 years at a rate of interest of 10%, the institute can tell you yes, the correct answer is 12,762. Correct. Very simple. You have done this in your AFM paper also. So how do you calculate it? 1 lakh rupees is invested for a period of 5 years at a rate of interest of 10%. The institute will ask you to calculate the maturity sum. Maturity sum, future value mean the same thing. So 1 lakh rupees, we will use this formula multiplied by 1 plus 0.10 raised to power 5. Right, please make sure that you convert your percentage. Do not directly write it as 10. No, you need to convert it. Right, so 1 lakh multiplied by 1.10 raised to power 5. Let us calculate 1.10 raised to power 5. 1.10, 1.10. Press the multiplication button once. I am pressing it once, and then I will press is equal to button 4 times. So 1, 2, 3 and 4. This is giving me 1.6151. 1.61051. Okay. So I can write it down as 1.61 or 1.60. Okay. So simply now I will multiply this 1 lakh rupees with 1.61 and I will have the answer. Clear? You gave two zeros less. 16 lakh 10,000. Kamla, 16 lakh 10,000, not 16,100. Okay? So the correct answer will be this. Clear, everyone? How do we use the formula is clear. This is the answer. 16 lakh something goes on in multiplication. Okay? All right. So this will be the correct answer. 1 0 is extra here also. Okay. So this is the answer. This is the answer. One extra zero is here. Ignore it. All right. Yes, it came out to be 51. It was rounded off. If in your numerical questions in the exam, exact values are not given, you need to round it off to the nearest one, right? If it is close to 0, we will take it. If it is close to 1, we will take the other side. Round it off to the nearest value. This is how we calculate the future value. Another way to calculate the future value is if the institute gives you the future value factor. This calculation, this 1 plus r raised to power n, what are we doing? We are calculating the future value factor. This 1.61 is the future value factor. Either you'll have to calculate it on your own, which is most probably possible. Another option is that the institute will give you the future value factors. Like in our question, the rate of interest was 10% for 5 years. So see, 10% for 5 years, already it is given the future value factor is 1.61. So if the institute gives you the future value factor table, you need not remember it. If the institute gives you the future value factor table, so you will directly check the rate of interest and the year, right? So you will simply multiply now the present value with the future value factor. Okay, so 1 lakh rupees multiplied by 1.61. So either you'll have to calculate it or it will be given as a table. Okay, this is another way. Now we also calculate the future value of annuity and annuity due. What is the meaning of ordinary annuity? Ordinary annuity. When the payments are made or received at the end of each period. Normally we make the payments, let's say I'm paying premium for insurance or I'm receiving interest on an investment at the end of the quarter or at the end of the annual year, I make the payment, I get the payment. Then it is an ordinary annuity. Annuity due means the payment will be made or received at the beginning of the year. So the payment will be kept for a longer duration. The formula for both are very simple. We will see how. So how do we calculate the future value of ordinary annuity? We need to see how much you can invest per period. We will use the formula of ordinary annuity, right, to find out how much you will have in the future. Okay, if you are paying the loan, then how much will be the total cost of the loan? This is the formula for calculating the ordinary annuity. For calculating the ordinary annuity. Okay, F is equal to A plus 1 plus I raised to power n minus 1 divided by I. This is the formula for calculating the ordinary annuity. A is the annuity, I is the interest rate, and N is the term. So let's say I want to calculate the future value of annuity due of 1000 rupees for a period of 5 years at a rate of interest of 5% per annum. How will I calculate it? The future value of ordinary annuity is equal to 1000. In the numerator, I will have 1 plus 0.05 raised to power 5 minus 1. And in the denominator, I will have 0.05. Alright. This is how I'm going to calculate the ordinary annuity. So we can simply do it. What should be the correct answer? Can you do the calculations for me? Do it with me. Okay, so 1.05 raised to power 5, 1.05 multiplication 1 and then 4 times is equal to 1, 2, 3 and 4. 1.27. Okay, 1.27 minus 1. 0.27 divided by 0.05. 0.727 divided by 0.05 is 25. Okay, 25. I will multiply it by 1000, 25,000. Somewhere here will be the answer, should be the answer. Is it? Is everyone getting this answer? 5525. Okay. All right. So the ordinary annuity will be 5525. Now, if I want to calculate the annuity due, the formula becomes very simple. In this same formula of ordinary annuity, I am adding one more point, multiplication with 1 plus R. Multiplication of the ordinary annuity calculation, 1 plus R. This is the annuity due. Okay, so the same formula will be written here. Just a second. Yes. So same thing I'm going to write down. 1000 rupees. 1 plus 0.05 raised to power 5 minus 1 upon 0.05 multiplied by 1 plus 0.05. Right? 1 plus 0.05. Okay. And if I do the calculation in this manner, somewhat what should be my answer? Let me check. So this will be 1.05 is equal to and 4 times this. You already did the calculations. You are very fast. Yes, the correct answer is 5,800. Huh, it is the correct answer. Around 5,801.9. But rounding it off, you will have this. Okay, so as you can see, the ordinary annuity was 5,000 and the how do we calculate the annuity due? Simply multiply it by 1 plus. Why are you getting this value? 26,700 and no, you did some calculation was wrong. The answer should be 5,800, 5,800. We will do it the numericals, then it will become clear to you. Okay. All you need to remember from here is that the ordinary annuity formula is this till here, and the annuity due you need to multiply it by 1 plus R, 1 plus rate of interest. Clear everyone? How are we doing it? How are we calculating it? Clear? Leave it for right now. Okay, leave it for right now. Continue with what we are studying. Then later on we will take it again. Okay, leave it for right now. Yes. Another way to calculate the future annuity is simply multiplying it by the CV factor, the compound value factor. When we were using the future value factor was being used. Here, when we are calculating the future value of annuities, we are using the compound value factor. So either you'll have to calculate this compound value factor, this is the compound value factor, or the institute will give you the table. There are very less chances that the institute will give you the table. So make sure that you understand and remember the formula, right? So simply multiply the annuity. So in our question, we took 5% as the example. It is not given here in the table. Let's say the rate of interest was 8% for 5 years. Then the compound value factor is 5.86. If the rate of interest is 11% for 3 years, then the compound value factor is 3.34. So multiply the annuity with the compound value factor and you will get the future value of annuity. All right. Here a question is given to you. If Miss Anusaya is paying a home loan installment of rupees 12,000 per year for a period of 6 years, how much she paid till the end of the loan period? Basically, what is the future value of an annuity of 10,000 rupees per annum, 11% for a period of 6 years? I have this question at the end also. We will do it. Okay. Let us calculate it using the CVA factor. What is given to us? It is given that 10,000 rupees at 11% for 6 years. See what is here? 10%, no, 11% for 6 years, 7.93, right? 7.93, 913. So simply multiply the annuity 10,000 rupees multiplied by 7.913, you will have the future value of annuity. If we calculate it using the formula, then also 7.913 should come. Okay, this was just an example. Hmm. How to calculate the present value? Simply reverse the future value, right? The future value formula was present value multiplied by 1 plus r raised to power n. How do we calculate the present value? Simply divide the future value here, take it here. Future value divided by 1 plus r raised to power n. This will give me the present value. For example, if 1,61,000 is the maturity value of investment invested for a period of 5 years at the interest rate of 10% per annum, find out the amount invested. So if the institute asks you the maturity value, you need to calculate the future value. If the institute asks you the amount invested, you need to calculate the present value. So use the formula. Present value is equal to 1,61,000 divided by 1 plus 0.05 raised, sorry, 10, 0.10 raised to power 5. This will give you the present value. All right. Just reverse the formula. It should be 1 lakh rupees. It should be 1 lakh rupees. Yes, the correct answer is 1 lakh rupees. Okay, so simply divide 1,61,000, 1,61,000 by 1.61 that we had calculated. Okay, and you will have this formula. You will have the value. Right? So that is all. Or another way is by using the present value factor. In the table, it will be given. So 10% for 5 years, 0.62 is given. 0.62, 0.61, whatever is given, you need to use it. Okay. This is how we calculate the future value and annuity. Clear? The formulae for future value, annuity due, everything is clear. Before I upload the PDF, what I will do, I will include in a single sheet all of these formulas for you so that you can use it for your reference. So a single sheet of formula. I've already provided you for module A. What I'll do, I will include it with your module A itself. So the whole formula for your whole RBWM syllabus you will have in one single sheet. Okay, clear? Till here is everything clear? Give me a confirmation. Is everything clear till here? Yes. Let us complete one more topic, capital gains, and then we will take a 5-minute break. Just one more topic we will complete and then we will take a break. Okay. So now we have the topic of capital gains. What is capital gain? If I sell a capital asset can be a movable property, immovable property, tangible or intangible property. It can even include jewelry, it can include archaeological collections, drawings, paintings. What is not included in the definition of capital asset? Stocks in trade, stores, or raw material. Let's say I am a retailer of mobile phone. I sell mobile phones. I have mobile phones that I have kept for selling in the market. This will not be a capital gain, right? Or bonds or securities other than those which are announced by the government. Personal effects excluding jewelry, archaeological collection, drawings, paintings, sculptures. These are capital gains. Okay. Other than this, if there is any personal effect, let's say clothes or shoes, they are not capital asset. Agricultural land in India. If there's an agricultural land in India which is not situated within the municipality or the notified area committee, town area committee, cantonment board, which has a population of not less than 10,000, then it is not a capital asset, right? Now, whether it is within the local area or limitation, the area is used, but you need not remember it. What you need to remember is that stocks in trade, stores, and raw material is excluded from the definition of capital asset. Now, what is the meaning of capital gain? When I purchased any of this capital asset, I had to pay the acquisition price, right? And when I'm selling it, I am receiving the selling price. Whatever is the difference between the price of acquisition and the price which is received as the sale consideration, it is known as the capital gain. And on the capital gain, I am required to pay the capital gain tax, right? Capital gains tax can be a short term capital gain tax or a long term, depending upon the number of years I hold it before selling it off. Now, what is the meaning of transfer? See, I've been using the term sale, but capital gains does not only involve sale. Apart from sale, it will also involve transfer of the property. If I give my rights to another person, or compulsory acquisition, the government has compulsorily acquired the property, my property. Conversion of the capital asset into stock in trade, maturity or redemption of a zero coupon bond, allowing the possession of immovable property to the buyer, any transaction which gives the right to enjoy the immovable property to any other person, disposing of or parting with the asset, right? So all of these are known as transfer. Whenever such transfer is there and there's a capital gain, we need to pay the capital gains tax. Now, let's say I acquired a house. If I purchase the house, capital gains is there. But if I got the house as a gift, or my mother or my father gave the house as inheritance to me, right? So let's say father gave their daughter a house, it is not a capital transfer. But if the daughter or the son, they sell off the house to a third party, now this will be known as a capital transfer. All right, any gift or transfer, inheritance is not a capital transfer, but the person who is receiving the capital asset, if they sell it off to any third party, then the capital gain will arise in their hand. They will be required to pay the capital gains tax, right? If let's say there are special provisions in regarding of gift or will, if the gift, the value of the property received as a gift is more than the certain value stipulated by our income tax act, then the tax will be paid, otherwise not. Now coming back to this situation, let's say a father bought a house in 2020. They gave the house as inheritance as a part of their will to their son in 2021. The house was sold by the son in 2022. Now, the rules require that for being classified as a capital gain, a long-term capital gain, the property should be sold after 24 months or 2 years. In this scenario, this son had sold the property within 1 year only, 12 months, but we will consider it as a long-term capital transfer. Why? Because the father had originally purchased it in 2020, right? So in the case of a gift or inheritance, the cost of acquisition will be the cost of acquisition to the previous owner, what the father had paid to purchase the house, and the period of holding of the capital asset will be computed from the date of acquisition of the capital asset by the previous owner, by the father, not by the son. All right, this is a very, very important point that will definitely be asked by the institute. Okay, so if it is a acquired property is inherited or it is gifted, then the person receiving the gift from the original owner, they will take into consideration the cost that was paid by the owner and the time period for which they held. That is why we are considering this example as a long term capital gain, right? Now coming to the concept of short term and long term capital gain. Short term capital asset means a capital asset which is held for a period less than 36 months. Less than 36 months, it is a short term capital asset. More than 36 months, it is a long term capital asset. However, in case of immovable property, the period has been reduced. Now it is 24 months instead of 36 months, 2 years instead of 3 years. And in case of certain assets like shares or equity preferences listed in a recognized stock exchange in India, units of the unit equity oriented mutual fund, listed securities like debentures and government securities, units of the unit trust of India, zero coupon bonds, the period is 12 month. All right, so please, please, please remember the short term capital asset for immovable property, the period is 24 months. For these categories, the period is 12 months. Let's say there is a share which is not listed on the recognized stock exchange of India, 24 months. Equity oriented mutual fund will be 12 months. Not listed securities again will be 24 months. Okay, so remember these highlighted points. Short-term capital gain on the property, gain from selling a property which was held by the assessee for not more than 24 months. Right? The liability will depend upon the section 111A of the Income Tax Act, and it is significantly high if the assessee falls in the higher income tax. Okay, now the assessee is allowed to adjust or reduce the sale consideration for any brokerage. Let's say They acquired the property at rupees 20 lakh, and after 1 year they sold off the property and they received as a transfer rupees 30 lakh. So this is the cost of acquisition and this is the cost of transfer or consideration, not transfer. We will use the term consideration. The sale consideration. Now, to have this sale consideration, help of a broker was taken by the owner. To that broker, they paid rupees 50,000. This 50,000 they can reduce from the capital gain. So the capital gain will now not be 10 lakh, it will be 9 lakh 50,000. Sorry, it will not be 1 lakh, it will be 95,000. All right. No, 10 lakh. 20 lakh and 30 lakh was the example. Basically, what we can do, we will reduce the brokerage amount, whatever was paid by the owner, and then the capital gain will be determined. They will adjust the sale consideration for any brokerage, commission that the taxpayer had to pay. They will also deduct any expenditure on the construction and home improvement incurred during the period. Let's say the person, let's say Miss A purchased the house at 20 lakh rupees in 2021. In 2022, they incurred rupees 1 lakh for its improvement. And in 2022 December, in the same year, they sold it off at rupees 30 lakh, right? So when we calculate the capital gain, the short term capital gain, we will do what? We will adjust this consideration. We will deduct this 1 lakh rupees which I incurred during the period, which Miss A incurred during the period for which they held the asset, right? However, inflation adjustment is not allowed for short term capital gain. Inflation adjustment is allowed only in the long term capital gain. Also, no tax exemption is allowed on the savings on the short-term capital gain by reinvesting in the property or buying capital gains. There are various sections. I hope you remember section 54B, section 54 EC, G, GA. Wherever I have the capital gain, I can reinvest it into buying another house property or another agricultural land or another industrial land, or I can invest in the specific bonds issued by the NHAI or the rural electrification. These benefits are there in the long term capital gain, they're not there in the short term capital gain. All right, so these are the features. Long term capital gain, any capital asset held for more than 24 months immediately prior to the date of transfer, prior to the date of sale. In respect of certain assets like the equity or preference shares listed on the recognized stock exchange, same category, we consider it 12 months. In case of unlisted shares, it is considered 24 months. In case of immovable property, earlier it was 36 months, now it is 24 months. So if I buy the house in 2020, I bought the house in 2020, I sold it after 2023, after, then it is known as what? Or even 2022, then it is known as a long term capital gain, right? Or if I purchase the shares which are listed in a recognized stock exchange and I sell it after 1 year, I purchased the equity shares in 2025 October, I'm selling them in 2026 December, then it is what? It is a long term capital gain. If I sell it before October 2026, it is a short term capital gain. These are very simple direct concept, but the institute will again give you a scenario. They will not ask you directly. They will give you a scenario. They will ask you to determine whether it is a short-term capital gain or it is a long-term capital gain. So you need to remember 12 months and 24 months. How do we calculate the short-term or the long-term capital gain? This is the formula. To calculate the short-term capital gain, find out the full value of consideration. Let's say the full value of consideration that I received after selling my house was 30 lakh rupees, right? Hmm. From this, I will subtract the expenditure of transfer. I had to pay rupees 50,000. I had to pay rupees 50,000 for to the broker. I had to, for acquisition, I acquired the property at rupees 20 lakh rupees, right? And the cost of improvement, I had to incur 1 lakh rupees on improvement. So these things will be subtracted from the sales consideration. Whatever value is left is known as my short term capital gain. From this, if exemptions are available under section 54B and section 54D, section 54B is selling of a capital asset other than, no, it is agricultural land, right? Short term capital gain arising out of the transfer of agricultural land. Only two sections are there for short term capital gain: 54B, selling of the agricultural land, purchasing another agricultural land, and 54D is there, right? 54D, industrial land, right? Transfer of the land or any building which is of industrial use, and it is compulsory acquired by the government. Any building, land which is for industrial use, compulsorily acquired by the government, and it is reinvested in acquiring land or building for industrial purpose again. Then these two sections can be claimed as deduction under the short term capital gain. Okay, so from X minus the whatever amount is there in section 54B and section 54D, whatever is left is the short term capital gain. Remember this part. Numerical questions are not that probable, but theoretical questions will be asked. Conceptual. Which exemptions are available under the short term capital gain? So remember 54B and 54D. 54B agricultural land, 54D industrial land. How do we calculate the long term capital gain? Now, whenever long term transfer is done, there is the effect of inflation, right? So in the case of long-term capital gain, rather than using the cost of acquisition and cost of improvement, we are using the indexed cost of acquisition and indexed cost of improvement. What is the index value is given by the government. The government releases the index value for every year, right? So find out the full value of consideration. Let's say the full value of consideration was 30 lakh rupees, right? From this, I will subtract the expenditure 50,000. Index cost of acquisition. Formula for index cost of acquisition is cost of acquisition 20 lakh rupees multiplied by cost inflation index of the year of the transfer. I sold the asset when? I sold the asset in 2024. Okay, divided by the CII of the year of acquisition. When did I buy the asset? I bought the asset, for example, in 2021. All right. So this is how you calculate the index cost of acquisition. How do you calculate the index cost of improvement? The cost of improvement was 50,000 rupees multiplied by the year CII of the year of transfer. So CII of 2024 divided by CII of the year of improvement. Let's say this 50,000 rupees I spent on improvement in the year 2023. So CII of 2023 will be used. All right. Once I calculate this index cost, I will subtract it from the full value consideration. Then various exemptions are available in the long term capital gain. 54, section 54, if I sell a residential house property, I reinvest the capital gains to buy another residential house property, I can claim it as a deduction. 54B agricultural land, 54D industrial land, 54EC any capital asset. long-term capital gain arising on transfer of any capital asset if it is reinvested in the bonds issued by NHAI or Rural Electrification Corporation, right, within 6 months from the date of transfer of the capital asset. Okay. And section 54F. Section 54F gives the benefit for capital asset other than a residential house property. If I am selling off equity shares or bonds or debentures other than a house property and I'm investing it to buy one residential house property in India or for the construction of one residential house property in India, right? All of these deductions will be subtracted from here, and then the balancing amount is known as the long term capital gain. All right, it is known as the long term capital gain. Why do we use the indexation? Because the cost of acquisition is to be adjusted against the inflationary rise in the value of asset, and the government notifies this cost inflation index for every year. We need not remember the table, but it is available only for the long term capital asset, not for the short term capital asset. How do we calculate the computation? The index cost of acquisition and improvement. This is the formula. So what you need to do, you need to remember the capital gains. How do we calculate the capital gains? Short term and long term. You also need to remember the computation of the index cost of acquisition. Now in this table, we took the example, right? So let's say 20 lakh rupees was the consideration. We are calculating the index cost of acquisition. So the year in which I transferred the property, let's say I sold off the property last, it is given in 2022-23. So 331 divided by the year of acquisition. Let's say I purchased the property in 2018-19. So divided by 280. This will give me the index cost of acquisition. Index cost of improvement. The cost of improvement was 50,000 rupees multiplied by the year of transfer. So the year of transfer was what? 2022-23, 331 divided by the year of improvement. CII of the year of improvement. Let's say I did the improvement in 2020-21 divided by 301. All right. This is how I calculate the index cost of acquisition and the index cost of improvement. Simply, I will use these values in the formula for the capital gains and I will have my answer. Clear, everyone? How are we calculating the capital gains, the index cost? Everything is clear? Please give me your confirmation. Yes, I need your confirmation. And then we will move on to the remaining topic from our capital gains. Is it clear, everyone? The calculation is clear. Yes? Okay. Now, the various sections that I told you that you need to remember. Which sections you need to remember? 54 is important. 54B is important. EC is important. 54, I purchased the house in 2020. I sold the house in 2024. Long term capital gain. If I use those proceeds, whatever was the capital gain, the difference between the sale price and the consideration price, into purchasing or the construction of one residential house property in India, I can claim the deduction. That means the capital gains will be exempted. I will be eligible to claim the exemption. 54B is available both to long term or short term. Transfer of agricultural land. If I transfer the agricultural land and I use the capital gains to purchase another agricultural land, I can claim the deduction on capital gain. EC, long term capital gain on transfer of any capital asset. It can be a house, it can be a agricultural land, industrial land, it can be securities, shares, debentures, jewelry, whatever. If I use the proceeds, the capital gains, investing in the bonds which are issued by NHAI or REC, it has to be done within a period of 6 months. Okay, then I can claim the deduction. This cannot be claimed for short term capital gain. Please remember, it is only for long term capital gain. Sorry. Section 54 EC. Section 54 EC, again, long term capital gain arising on the transfer of any capital asset to be reinvested in the finance startups, to be reinvested in the specific fund created by the government to finance the startups. You need not remember section 54 EE, not important. 54F, again, the long term capital gain of transfer of any other capital asset other than the residential house property. 54F is only residential house property. 54 and 54F is about any other capital asset. If I reinvest it in buying or getting constructed another house property, then it is a exemption. This is section 54F. 54D, compulsory acquisition by the government. If my land is being compulsorily occupied, acquired by the government, and if it is an industrial land, I can reinvest it into buying another industrial land or a building. 54G, not important, basically transfer of land, building, plant, or machinery in order to shift an industrial undertaking from an urban area to rural area, reinvested in the same purpose. GA is also not important. Basically, any plant machinery shifting from an urban area to a special economic zone, reinvested in a special economic zone. And 54GB, long term transfer asset on the transfer of a residential property to be invested in an eligible startup. Right? So these are the sections where I can claim the deductions on my capital gain. Now, the various conditions to be fulfilled so that an individual can claim the deductions under Section 54. It is available only to individual or HUF. The residential house property sold to be reinvested in another residential house property only to individual or HUF. It should be a long term capital asset and a residential house property. Commercial house property not allowed. Short term capital asset not allowed. Now, if I am selling the house in 2025, then I should buy another residential house either 1 year prior to the sale or within 2 years, within 3 years from the date of transfer, right? The taxpayer should get should acquire another residential house or should get constructed another residential house within a period of 3 years from the date of transfer or within a period of 1 year before or 2 years after the date of transfer of the old house. All right. So, if I am buying a new house, either 1 year before or within 2 years from the transfer, if I'm getting the house constructed, then within 3 years from the date of transfer, it should be completed. Only then I can claim the benefit under Section 54. Exemption can be claimed only for the residential house property purchased or constructed in India, not outside of India. And if more than one house is purchased, then the exemption will be available for one house only, right? If I'm using the proceeds, the capital gains to invest in more than one house, I can claim the benefit for one house only, not for both. And for purchase outside India, I cannot have the benefit. Then there's the concept of capital gain deposit account scheme. Let's say I have sold off the asset and before I could purchase or get the house constructed, I had to file the income tax returns. In that scenario, will my exemptions be forfeited? No. I still have the option. I can deposit these proceeds in the capital gain deposit account scheme And then later on, I will use this to get purchase the house or get the construction completed, right? So the taxpayer should purchase another house within a period of 1 year before or 2 years after the date of transfer, or the construction should be completed within a period of 3 years from the date of transfer. If till the date of filing the return of income, the capital gain arising is not utilized, either whole or part, then the benefit can be claimed by depositing the unutilized amount in this capital gain deposit scheme, which are provided by any branch of any public sector bank in accordance with the capital gains deposit account scheme. And then later on, within 2 years or 3 years, I can purchase the house or I can get the house constructed. All right. So this capital gain deposit account scheme will be available only if the ITR condition is there. If I have to file the income tax returns and before that I could not utilize it. Now there's the concept of loan calculator and the loan amortization schedule. How do we do it? You need not remember it. It is done through the computers, right? Manual, it is not required now. Just remember the concept. If I am taking a home loan, I want to analyze the various loan options that are available. This can be done by using the loan calculator. How the loan calculator works is not given in your syllabus, is not of your concern. This exercise will show you how to create a simple, reusable loan calculator to determine the monthly payment based on the loan amount, interest rate, and term, right? So loan calculator will tell me the various loan options available. I am going to analyze which type of loan should I take. So the different types of loans will tell me what will be the total interest, what will be the loan amount, what will be the total term. This is the loan calculator. Loan amortization will tell me how much interest is being paid in a given year. Okay, so the loan amortization schedule is an addition to the loan calculator. If I want to choose between the best options, loan calculator. If I want to see how much interest I am paying in a given year, then the loan amortization schedule is used, right? But how do we do it? Not important. With this, we have completed our unit 29 as well. The mortgage advice is done. Clear, everyone? Is everything clear? Any doubts, any queries, any questions? If you have, then you can ask. Any doubts? Is everything clear? Is everything clear? Please give me a confirmation. All right. Now we have the unit 30, which is valuation of real property. This unit is basically theoretical. Theoretical questions will come from here. Two topics are very important: sinking fund, which will include depreciation, and the reverse mortgage. The concept of sinking fund and reverse mortgage, right? What is the meaning of valuation? Valuation of the property. Whenever the bank is doing the appraisal of the loan application, they are taking some property as security or mortgage. They will do the valuation of the property, which is done by qualified engineers and architects who possess knowledge of the building cost, awareness of the market condition. This is important that you remember. The valuer needs to be certified. Who gives registration to these certified valuers? The income tax department grants registration to the valuers under the section 34AB of the Wealth Tax Act 1957. Based on their technical background and their experience, they will apply to the income tax department and they will get their registration. Now, to do the valuation, there are different kinds of property. immovable property, agricultural land, plant and machinery, jewelry. Different types of valuers get different registration. This is given by the Institute of Valuers. It is a professional body that grants membership to the practicing valuers. So registration is done by the Income Tax Department under the Wealth Tax Act. Each valuer, before they get their registration, before they make their application for registration, they should get their membership from the Institution of Valuers at Delhi, right? So besides registration, they also need membership or fellowship of the institution. Now we are going to discuss the methods to do the valuation of the different types of property. First, we have an agricultural land income capitalization method. We will assume that the land has been given on lease. There is a tenant on a sharecropping basis. The owner has given the land on lease to a tenant. They are doing the production on the land, and then the crop is shared between the owner of the land and the tiller of the land. So we will assume that the land is rented on the crop sharing basis. How do we assume the rent? From the local taxes, the cost of maintenance, the cost of input. So this is income capitalization method. Assume. Assume that the property has been given out on rent. Then capitalized value means amount of money required today to get a certain fixed income in the form of annual installments in the future. So this is the future value, right? We calculate somehow the future value. How do we calculate the future value? It is obtained by multiplying by it by a factor called the year's purchase, right? So whatever is the value today, present value multiplied by the year's purchase, which is a factor released by the concerned department. How do we calculate it? Not important. Just remember the concept. You need to remember the concept. In the income capitalization method, assume that the property is rented. In the capitalized method, assume what will be the fixed income in the future. In the sales statistic method, it is comparison. What is statistics? Statistics is presuming probability. So I am calculating the probability depending on the information I have. Information I have of the similar land in the vicinity. So the size of holding, physical features, title of the land. A similar land which is sold recently in the previous 2 or 3 months, I will assume that the property will be valued at the same value. Then we have the urban land. Various factors influence the value of the urban land. Encumbrances on it, Vastu Shastra, size and shape, location, soil quality, water availability, usage, many things. What are the methods? First, comparative method. We will compare the same type of property, an urban land, with another urban land in the vicinity that was sold very recently, right? Whatever value was derived from that property will be assumed to be the value of this property under consideration. So we are comparing it, comparative method. Rent capitalization, I assume that the urban land, let's say a building has been created on a similar land in the vicinity, and that building has been given out on rent. Whatever rent that building on that urban land is generating, I will assume it for this particular land as well, right? So the rent capitalization method is calculated by multiplying the net income by the years purchased, right? Okay. Then belting method, we see what are the characteristics of the property, frontage and depth of the plot, right? The land which has more depth, more frontage, bigger plots will have more value, right? So exact belting is done. Extraction method means from a developed property, urban land, a building has been created and we are comparing it to get the value of it. If the land is developed, what will be the value of it? It can be adjusted for the difference in size, shape, location. That is the extraction method. Guideline means the various municipal authorities, departments, they conduct the survey, they collect the various duties and taxes. So the government authorities, they publish the guideline value for the relevant period and location. That can also be taken as a reference. Then a land with building, simply I will take the comparative method where I will collect information on sales rate. Meaning of comparative method is same in all the kind of property, whether it is agricultural land, urban land, land with building. I will compare this land with another land of the similar type that has been recently sold in the recent past. Okay, that is the comparative method. Rent capitalization, again, I will see what has been the rent paid on a similar property. I will assume it to be the rent of my property, which is under consideration, which is under valuation. Okay, valuation based on profit. Now, there are certain types of buildings that derive their value from the profit, like a hotel, a cinema house, restaurant, pub, right? A bar. So here we take the profit into consideration. In case of the property which is being used for conducting trade or business, now we will use the capitalized value of the net profit. Which type of properties are we talking about? Hotels, cinema houses, restaurants, etc. Valuation based on cost, the cost incurred on the construction, age, and condition of the building. Appropriate depreciation will be charged, and then we will arrive at the valuation of the property. Encumbrance factor can also be taken if the value imposed of the land due to the type of structure erected on it. Some types of land or buildings like hospitals, schools, police station, libraries, temples or mosques, these are special type of building, right? We not take into consideration the profit of it, we take into consideration the full economic value where the instances are not available for comparison. Then we will take the encumbrance, right? Another bank would have given a loan on that property, we can check that what has been the encumbrance factor. Development method, potential value of the property if it is developed in the best manner. Let's say there's an open land, on that apartment is to be constructed. If we construct the apartment in the best possible manner, what will be the potential value of it? What price would the buyers be ready to pay for the flats? That is known as the development method. Specialized buildings, I already told you, the bars, breweries, hotels, motels, cinema houses, experience of market rules are there. The business can be pursued only after getting a license. So, in this scenario, not just the value of the premises, we also need to take into account the value of the intangible asset, like the license, the goodwill, monopoly. All of these things will also be considered in the valuation of specialized building. Okay. Now, if the institute asks you questions from these type of topics, if even if you don't remember the exact definition, what you will do, you will understand that the meaning, what is the meaning of a specialized building, what is the meaning of comparative, what is the meaning of development. Use the basics of English language and apply your knowledge, apply your common sense, and mark the answer which you think is correct, right? Most probably it will be correct. So if you're able to remember it, well and good. If you're not, don't worry about it. Use your common knowledge and you'll be able to answer it, right? So valuation requires a proper assessment of the gross income of the business, shops, establishment should be done. Now, we come to the point of sinking fund. Whenever the bank is giving out a loan and they're accepting a property as security for mortgage, they will not only consider the present value of the property, they will also consider how much life is remaining of the property, the future life of the building during which it can yield an assured income. Normally, buildings they vary from 40 years to 80 years. If a building had been constructed before 80 years, obviously the bank is not going to consider it, right? Or 40 years. If the building has been constructed within 5 or 10 years, it will be good for the bank to take it as mortgage, right? So there's the condition of depreciation due to wear and tear, new construction technology, proper maintenance is not done. That can also lower the life of the property. So the life of the structures should also be considered. Now we come to the now we come to the sinking fund. Sinking fund. If let's say a building was constructed in the year 2010, right? The building was constructed in the year 2010. Certain funds should be kept aside by the owner. These funds will be used for the maintenance, repair of the property so that it continues generating income for the owner, right? So at the end of the life of the structure, when it ceases to yield desired income, the property has to be rebuilt or it has to be replaced so that it can continue for a further period. So this is known as the sinking fund. The fund which is set aside for the purpose of recovering the original capital is known as sinking fund, right? The amount will be set out annually. At once we will not set out the fund. Annually a percentage will be kept. It depends upon the compound interest. The sinking fund factor is the amount that accumulates to rupee 1 if invested at the specified rate of interest for the certain number of years. All right. So all you need to do is remember the meaning of sinking fund. Now depreciation. When we continue to use a particular asset, I'm living in a house, normal wear and tear, weather conditions, technology, all of these will lead to fall in the value of the asset. Deterioration in the physical condition as a result of usage or the effect of climatic conditions, poor structural design, or let's say the workmanship was poor. Also, obsolescence. Obsolescence means when the technology becomes outdated. Then it is known as depreciation. Depreciation means the loss in value. So, when we are keeping the sinking fund, we also need to take into account this depreciation. Now, in your syllabus, two methods are given to calculate the depreciation. First is the straight line method, and second is the written down value method. Again, I know you have already studied about it in your papers, the previous papers. Straight line method means straight, uniform. Every year, I am going to keep certain amount. We will decide that this is the amount will be depreciated uniformly. So the depreciation is allocated uniformly over the life of the property. And this method is generally adopted for the tax purposes and preparing the financial statement. Okay, so how do we calculate the annual depreciation? Original cost minus the salvage value. Salvage value means the value that the property may fetch at the end of the useful life, and we determine it by the we divide it by the n. N is the life of the building in years, right? C is the original cost minus the salvage value divided by n. We will do the numericals on it so you will understand it. For now, just remember this formula for straight line method. Uniformly, we allocate the depreciation. Second method is written down value method, where we assume that the property will lose value by a given percentage, a constant percentage. So in the beginning, let's say 5% is the written down value method for depreciation. The cost was 50 crores of construction. 5% of 50 crores for the first year. Then whatever is left, 5% of that value. Then whatever is left, 5% of that value. Okay, so the depreciation goes out, reducing every year because the depreciation is constant, 5%. but the capital value of the asset decreases, right? Thus, the written down method is also known as the declining balance method. The straight line method is used for the tax purpose and financial statement preparation. The written down value method is used by the industrial units so that they can take the advantage of the lower income tax. How do we calculate the written down value depreciation? It is C minus P multiplied by N. C is the original cost. N is the life in years of the property, the total years that it has, and minus P. P is the percentage of depreciation, let's say 5%. And here we do not assume anything remaining at the end of the life of the property. It is the salvage value. The value of the property, the depreciation is going down, so salvage value is assumed to be 0. All right. So these are the two formula for depreciation that you need to remember. The written down method and the straight line method. Now we are left with the concept of reverse mortgage. Last topic. Last topic. Just bear with me. Okay. Normal mortgage is what? In the normal mortgage, I keep my house as security in the mortgage. In the beginning, I will have zero interest over it. My stake in the property, my ownership in the property will become zero. As I keep on paying the principal and the interest, the EMIs are paid, my stake in the property keeps on increasing. And once the whole loan amount has been repaid to the creditor, I will get back the property. That is the normal mortgage. In the reverse mortgage, opposite happens. In the beginning, my stake in the property will be 100%. And by the end of the loan term, my stake will become zero. The bank will take the property for me. So this reverse mortgage concept has been developed basically for the senior citizens, right? In the normal housing loan, the property being purchased is mortgaged. The borrower avails the loan and their stake in the property purchased is low. As the regular EMI is paid, the loan amount reduces and the stake in the property increases. In the reverse mortgage, the situation is opposite. The borrower initially retains a high stake in the property and they receive a regular cash flow. So the borrower does not pay anything to the bank. The bank pays a regular cash flow to the borrower. When the loan amount increases and at the point the loan amount becomes equal to the value of the property, then they will lose the property. Okay, so in the beginning, they have the stake. By the end, they will lose the property. So this reverse mortgage loan was introduced in 2007. Many banks like SBI, CBI, they have issued their guidelines. It is developed by the NHB to help the senior citizens so that they can avail periodic payments from a lender against the mortgage of her or his house. So if at any point there are any chances that the parents feel that their children are going to send them away from the house, they can take this reverse mortgage loan. The house will be kept as the mortgage. They can continue to live here. They will continue to live here. They will receive the payment from the bank. And after their death or whenever the loan amount completes, the bank will take over the property. If their nominees, their children, they want to claim the house, they will have to pay the whole loan back to the bank. The parents, the senior citizens, they will not pay anything to the bank if they do not want the house at the end of the loan term, right? So this is a benefit for the senior citizens. This is the borrowers. They are not required to service the loan during their lifetime. They do not make monthly repayment of principal and interest to the lender. The lender is making regular cash flow to the borrower. The borrower is paying nothing during their lifetime to the lender. RMLs, they are extended by the primary lending institutions, scheduled commercial banks, housing finance companies. Eligibility criteria. Indian citizen who is above the age of 60 years of age, they can avail it. Let's say there's a husband and wife. One of them should be more than 60 years, and the partner should not be less than 55 years of age. They are eligible as joint borrowers. The age criteria would be at the discretion of the lender. At least one of them should be above 60 years of age, and the other one should not be below 55 years of age. They should be owner of the residential property. It can be a house or a flat. Commercial property not allowed. Right? So whoever is taking the loan, they are taking it only on the residential property. Then the residential property should be free from any encumbrances, and at least 20 years residual life should be remaining, and it should be used by the borrower as their permanent primary residence. Commercial property is not eligible. Only residential property in which they are personally living, they can take the loan. Now, maximum monthly payment that the bank is going to make is 50,000. This is a good amount. This is maximum. Lump sum. At the end, the maximum lump sum payment will be restricted to 50% of the total eligible loan amount, subject to a cap of rupees 15 lakh, and it can be used for the medical treatment of the self, spouse, or dependents, if any. So, monthly payment 50,000, 15 lakh rupees will be given by the bank in case of medical treatment. Okay. Now, in the reverse mortgage, I already told you the basic concept is what? It is for the senior citizens above 60 years of age, right? All the payments that are made, the loan that is used by the senior citizen can be used for various purposes. They will be exempt from income tax. Any transfer in a reverse mortgage will not be regarded as a transfer because the bank has the ownership, right? Now, in case the borrower outlives the loan tenure, that is, the senior citizens, they do not die. They will remain the owner of the property, and at the end, they can pay off the loan. Or on their death, if they nominees or not nominees, if they're children, they want to get the house, they have to pay the loan back to the bank. Right? The legal hires, they have the option of prepaying the loan without any prepayment levy as well. Okay, so this scheme is available for the entire country, including the rural areas. All right, clear, everyone? The concept of valuation, the concept of reverse mortgage, the depreciation, sinking fund, everything is clear. Please give me a confirmation. Give me a confirmation regarding this. Yes? Okay. Now we have questions from our module module E and module A. Do you want to take a break or do you want me to continue with the questions? I am fine. I do not need a break. If you want a break, we can take a 5-minute break and then we can continue. Now we only have questions. Questions from module E and module A. Theory plus numerical. Tell me, continue or break? Shall we continue? You want 5 minutes break? Okay. Let us take a short break and we will continue after 5 minutes. All right. 5 minutes break. 5 minutes break. Okay. So we will meet at 9:35. Sorry, 9:40. 9:35 it is right now. 9:40. Okay. Yes. Is everyone back? So we took a 10 minutes break. All right? Okay. Everyone who's here, please let me know that you are back and you are ready for the questions so that we can start. Before I start, I want all of you to tell me that you are here and you are ready to answer these questions. Everyone is going to answer. I will give you 10-15 seconds. You need to drop down your answers and then we will discuss the correct answer. We are starting with the numericals now. The break is over. Everyone's back? Okay. Yes, yes. All right. So keep your calculators ready. And here's the first question. A person deposits 5,000 rupees annually for 5 years at an interest rate of 8% compounded annually. What is the future value of this ordinary annuity? You need to calculate the future value, ordinary annuity. I will not tell you the formula. You need to solve it on your own first, and then we will discuss. Everyone. First, tell me the formula for it, for calculating the ordinary annuity. Start calculating, everyone. I want your answers. 5,000 rupees annually for 5 years at an interest rate of 8%. What is the future value of this ordinary annuity? So, what is the formula? How do we calculate it? Future value is equal to whatever is the present value or annuity multiplied by 1 plus r raised to power n minus 1 divided by the rate of interest. Yes, so this is 5,000 rupees multiplied by 0.08. Rate of interest is 1.08 raised to power n is 5 years minus 1 divided by 0.08. Okay, so let us calculate it together. First, we will calculate the value of 1.08 raised to power n raised to power 5. So multiplication once and then 4 times is equal to 1, 2, 3 and 4. It should be 1.4693, right? So 5,000 multiplied by 1.4693. This is what came in the numerator minus 1 divided by 0.08. Kamla has answered A. Anyone else wants to try? So let us calculate this value. So 1.4, no, I will subtract 1, right? So 0.4693 multiplied by 0.08. It is 5.86625. It is coming 5.86625 multiplied by 5,000. Everyone till here? The same steps are there. You are following through. Okay. Now multiply this value 5,000 multiplied by 5.86625. It is 29,331. 331.25. Okay, 321, 31, whatever. Everyone is getting this answer or not? Multiplied by 5.86625. Yes, this is the correct answer. Is everyone getting 2,933? 2,933, sorry, 29,331.25. Is everyone getting this answer? Forget about what is given in your options. Just tell me, are you getting this answer or not? Are you getting this answer or not? I'm not getting your answers. Why? Please try to be active. You guys, please try to be active. Yes, you're getting this? Okay. So the correct answer is A. Alright, so the correct answer is A. The calculation is given to you, but the answer is given incorrect. It should be A. The correct calculation is 29331.25. Alright. A person deposits 10,000 rupees annually for 6 years at 9% interest, which is compounded annually. Using the annuity value factor, calculate the future value of this ordinary annuity. Very simple. Very simple. The future value factor is already given to you. So how will you calculate it? Here in this question, the future value is already given to you. So how are you going to calculate it? 9% for 6 years, it is 7.523. Multiply it by 10,000, which is our deposit, which is done annually. Right? So the correct answer will be A, 75,230. All right? Closest answer? Yes. Next. A person deposits 2,000 rupees at the beginning of each year. Oh, I've already given you the solution. All right, let us for once ignore this solution and try to calculate it on our own. A person deposits rupees 2,000 at the beginning of each year for 4 years at 10% interest rate compounded annually. What is the future value of annuity due? Now you need to calculate annuity due. Why? Because at the beginning of each year, the deposits are being made. So this is the formula, right? This is the formula for annuity due. Future value is equal to present value multiplied by 1 plus r raised to power n minus 1 divided by r multiplied by 1 plus r. So let us write it down. 2000 multiplied by 1 plus 10 raised to power 4 minus 1 divided by 0.10, right? And multiplication with 1 plus r, so 1.10. This is the calculation, right? And then we will have the correct answer. According to them, it is 9,636. Let us calculate it on our own. So 1.10 multiplication once and is equal to 3 times 1, 2, 3. I have 1.46, right? 1.4641. It will become 2000 multiplied by 1.46 divided by minus 1.46, okay, divided by 0.10 multiplied by 1.10. You will not cancel it out, right? Don't cancel it out. Are you getting this answer by the calculation? So the calculations are very simple. All you need to do is remember the formula for ordinary annuity and annuity due. Here we already have the solution, so I don't think we need to worry about it. Let us move on to the next question. Clear? How are we calculating the annuity and annuity due? Ordinary annuity is clear? You're not getting this answer? Let us do it on our own then. Let us do it on our own. So 2000 was there, right? Multiplied by 1 plus the rate of interest is 10%. So 1.10 multiplication 1, 2, 3. Why is this coming? Wait. Hmm. 1.10, 1, 2, 3, 1.46, 2000 It is 1.46 divided by 0.10 and minus 1 here, multiplication by 1.10. Okay, so 0.46 divided by 0.10 will give me 4.6, 4.6, right? It is 4.6. 2000, 2000 multiplied by 4.6 multiplied by 1.10, right? So 2000 multiplied by 4.6 multiplied by 1.10. It is, yes, it is 10,120. It is 10,120 is the correct answer. So the correct answer is not given to you. Yes, your calculation is true. That is why I'm telling you, don't worry about the calculation here. Just remember how to apply the formula. 10,120 should be correct. 10,120 should be correct. Okay, all right. Let us now solve some questions on capital gain. Mr. A sold shares for 2,50,000. He had purchased them for 10 months ago for 1,80,000. He incurred 5,000 as brokerage on sale. What is his capital gain? What is his capital gain? What should be the capital gain of Mr. A? So how do we calculate it? 2.5 lakh minus 1 point whatever is the consideration, 1.8. So simply do it. I know you can do it using your calculators. Minus 180,000, right? 70,000. From that I will exclude the brokerage. So 5,000 is given as brokerage. 70,000 minus 5,000 is 65,000. This is the capital gain. Yes, this is the capital gain. From whatever capital gain is there, we can exclude the brokerage. Do not forget this point. Do not mark 70,000 as the correct answer. No. All right. Remember this point. A is the correct answer. Everyone. Great. Mr. B sold a plot of land for 1 crore 2 lakhs. Is it given? 12 lakh. Okay. 12 lakh. Mr. B sold a plot of land for 12 lakh rupees. He had purchased it in the financial year 2012-13 for 4 lakh rupees. Cost inflation index for the financial year 2012-13 is 200. Cost inflation year for the financial year 2023-24 is 348. The expenditure on transfer is 20,000 rupees. What is the long term capital gain? Obviously, it is a long term capital gain, right? It was purchased in 2012-13, sold in 2023-24, more than, I think it's 10 years, right? More than 10 years, 11 years. How do you calculate the long term capital gain here? The formula for the capital gain is the price of consideration minus the cost of acquisition minus the transfer cost. But here it is a long-term capital gain. That is why we will be using the indexed cost of acquisition. So calculate the index cost of acquisition first. How do you calculate the index cost of acquisition? Cost of acquisition multiplied by the year of transfer divided by the year of acquisition, CII, CII of the year of transfer, CII of the year of acquisition. So cost of acquisition was what? 12 lakh. Sorry, no, the cost of acquisition was what? 4 lakh rupees. The cost of acquisition was 4 lakh rupees multiplied by CII of the year of transfer is 348 and CII of the year of acquisition is 200. Okay, so first we will calculate the cost. So 4 lakh multiplied by 348 divided by 200. It is 69 lakhs and 6,000. Okay? Sorry, 6 lakh 96,000. 6 lakh 96,000. 69 lakh. Wow. All right. I will subtract this value from the consideration, right? So 12 lakhs minus 6 lakh 96,000 is 50,000, 5 lakh 4,000, and the expenditure on transfer. Is everyone following through? Yes. What should be the correct answer? Comment down the correct answer. You tell me your answer. Do not worry about the options. If your answer is not matching with the option, don't worry about it. Just tell me your answer. How much capital gains did you calculate? Yes, so for calculating the capital gains, we use the formula from the full value of consideration, deduct the expenditure of transfer and the index cost of acquisition, right? So the index cost of acquisition came out to be this, and the transfer was incurred of 20,000, right? Yes, so the correct answer is 4 lakh 84,000. It is not given. I think it should be 4 lakh 84,000. I wrote it as 8 lakh 4,000. It should be 4 lakh 84,000. All right, everyone? Yes, correct. 4 lakh 84,000. Is everyone getting this answer? Because I'm also getting it. I'm also getting the same answer here. Okay, let's move on then. So here the correct answer is 4 lakh and 84,000. Okay. A property costing 12 lakh rupees is to be replaced after 25 years if the sinking fund factor at 5% compound interest is 0.021. What annual amount must be set aside to recover the capital? You need to calculate the annual amount that must be set aside. You need to calculate the sinking fund to recover the capital. How do you calculate the annual sinking fund? Here, the direct value is given to you, right? The sinking fund factor is given to you. So simply multiply the cost of the property with the sinking fund factor. You will have the amount set aside to recover the capital. Okay, so it is given to us 12 lakhs multiplied by 0.021. It should be somewhere around 25,200. Another one extra zero is given to us. Okay, 25,200. Correct? Everyone is getting this answer. Is everyone getting this answer? How do you calculate the amount, annual amount that must be set aside? Simply multiply the cost with the sinking fund factor. By the sinking fund factor. It is already given to you. So you need not calculate the sinking fund factor separately. Multiply it, you will get 25,200 as the answer. A is the correct answer. Okay, A is the correct answer. Yes, everyone is getting it. Great. A property valued at 66 lakhs and 16,000 using the year purchase factor of 8.27. What is the annual income assumed? Again, this is very simple, right? This also we had studied in the valuation process. How do we calculate it? We divide it. In the sinking fund, we multiply it with the factor. Here, when we are calculating the we are using the year purchase factor YP, we divide it, right? To calculate it, so simply divide this value which is given to you, 66 lakh 16,000 divided by 8.27. So you'll have the value 6616 6616 yes, divided by 8.27. 8 lakhs. 8 lakhs is an option. Yes, A. 8 lakhs. Hmm, correct. Right? So remember both the formula. For sinking fund, you will use multiplication. For calculation the valuation using the YP factor, you'll be using this. 8 lakhs. Yes, 8 lakh is correct. Just a second. The year's purchase. This is what? This is the income capitalization method. This is the income capitalization method. Okay. Simply whatever is the present value or the cost, you divide it by the year's purchase. A is the correct answer. An asset costs rupees 5 lakh with a salvage value of 50,000 and a useful life of 5 years. What is the annual depreciation under the straight line method? Do we need to remember the sinking fund factor? No. Like in the question, the sinking fund factor was given, institute will give you the sinking fund factor. If they want you to use this formula, all you need to do is remember you need to multiply it. Do not divide it. All right. You need not remember the factor. Wherever future value factor, present value factor, CII, everything will be given in your question. All you need to do is use the values. Use the values. All right. Yes. So you need to calculate the depreciation using the straight line method. Straight line method. What is the formula to calculate it? C minus S divided by N. That is the straight line method. C is given to you 5 lakh minus salvage value is given 50,000 divided by 5. So 4 lakh 50,000 divided by 5, 95,000. No, wait, 9,000. 9,000, not 95,000, 9,000. Yes. A 9,000, A 9,000, clear. Correct. Again, I will repeat you. If you remember the concept, if you remember the formula, the numericals are very simple. Direct values will be given. All you need to do is put in the formula and you'll get the answer. A should be correct. Okay. Now an asset costs 2 lakh rupees and it depreciates at 10% per annum using the written down value method. What happens in the written down value method? Percentage depreciation is there, right? Percentage depreciation. What will be its value after 3 years? What will be its value after 3 years? The formula, first you need to calculate the written down value. You need to use the same formula, right? So what is the formula? It is C multiplied by 1 minus P raised to power n. 3 years. It is given, right? 3 years. So 2 lakh rupees multiplied by 1 minus 1 1.10, raise it to power 10, right? So 3, 1.10, raise it to power 3, 1 minus p, 0.90, right? 0.90. 1 minus p, right? 1 minus p is to be taken. 1.10. When you 1 minus 1.10 is 0.90. So 22 lakh multiplied by 0.90 raised to power 3. This is what you need to do. So 0.90 multiply 1, 2, 3. 729, right? 1, 2. 0.729. 0.729. So 2 lakhs multiplied by 0.729 will be 1,45,800. So here the round off value is given 1,46,000. We can mark it as the correct answer. Okay? Yes. So what is the formula? The written down value C multiplied by 1 minus P raised to power n. P is given 10%, so 0.10. 1 minus zero point 0.0 is 0.90. 0.90 raised to power 3 is 0.729. All right? Yes, so that is the correct answer. Okay. An asset that costs rupees 1 lakh and depreciates at 20% per annum using the written down value. What is the depreciation amount in the second year? Same thing, right? What is the depreciation amount in the second year? Now they have already given you. Now, if you remember the step by step written down value that we had calculated, year one depreciation will be what? 1 lakh multiplied by 20,000 will be the depreciation for first year. So it will be 20,000, right? 20,000 will be the depreciation for first year. Now we need to calculate the depreciation for second year. It will be calculated on this remaining amount. Remaining amount is 80,000 rupees. So now 80,000 rupee, 20% of 80,000 rupees. It is what? It is 16. Yes, it is 16,000. All right? Yes, the correct answer will be B. The step-by-step calculation. If they ask you to calculate for 3 years, then you will calculate on 16, 80,000 minus 16,000. Like this, if you remember, the whole formula was there 1, 2, 3, 4, 5, then multiplication 5, 4, 3, 2, 1. Like this, it was there. Yes, the correct answer is B. Okay. Those were the topics from your numericals. Now let us solve some theoretical questions as well. Let us see how much theory we have understood from our module E. Which of the following methods are used by the banks to minimize risk in loan origination? Requesting co-borrowers or guarantors, charging fees for processing and documentation, conducting a thorough credit appraisal, verifying the authenticity of the customer's information. Quickly answer. I want all of you to answer these questions now. Everyone. Which methods are used by the banks to minimize the risk in loan origination? Yes, the correct answer is D, 1, 3, and 4. Charging fees for processing and documentation will not reduce the risk, right? Co-borrowers, credit appraisal, and identification of the customer's authenticity that will reduce the risk. What are some key documents and verifications required to ensure the borrower holds clear and marketable title to the property? Sale deed, agreement of sale, and non-encumbrance certificate. Parent documents showing how the transferor acquired the title. proof of recent property valuation and RERA approval of housing project, personal guarantees and character certificates of the borrower. What, which of these documents will be used? Which of these documents will be used to ensure that the borrower holds a clear and marketable title to the property? Yes, what should be the correct answer? The correct answer should be A. Yes, it will be A. Personal guarantees and character certificate will not determine the borrower's holding. No, not 4. Right? Sale deed, agreement of sale. Let's say they purchase the property. So that will be checked. A is the correct answer. Which of the following is not a type of power of attorney relevant in the context of housing loan applications? Special power of attorney for specific judicial transaction, general power of attorney for representing or performing more than one act, springing power of attorney for some specific events, irrevocable power of attorney specifically for mortgage creation. Which type of power of attorney is not relevant in the context of housing loan applications? In the context of housing loan applications. Yes, what should be the correct answer? Springing power of attorney is not there, right? We have a specific, general, and irrevocable power of attorney. Okay. What criteria are typically used by the lenders to determine the eligibility for a home loan? Preferred age group and minimum salary or income level, credit score in the credit information report, number of dependents and the marital status of the applicant, specified areas or localities for loan provision. What criteria are used by the lenders to determine the eligibility of a home loan? Yes, what should be the correct answer? What should be the correct answer? The correct answer will be D. Right? D, 1, 2, and 4. Number of dependents and their marital status is not relevant to determine the eligibility. Right? So 1, 2, and 4. What is the criteria for the service eligibility when applying for a home loan for salaried individuals? Minimum years of service in the current organization, total years of professional experience, current job title and responsibilities, employer's reputation, and market standing. So, when a salaried individual is applying for a home loan, what eligibility criteria will be used by the bank? What will be the eligibility criteria? Employer's reputation and market standing. No. Employer's reputation will not be used. The bank will check the minimum years of service in the current organization. No, not the total years of professional experience. Let's say total years of professional experience is 25 years, but in the current organization, they have been employed for only 1 year. Will the bank approve their loan? No. They will make sure that they have a continuous source of income, a regular source of income. Right? For this, the minimum years of service in the current organization will be checked. Which of the following is not a key legal and valuation detail considered in the home loan process? Date and advocate's opinion on the title of the property, date of valuation and value of the property as per the valuer's report, whether the property is encumbered, and details of the existing loan, The historical significance of the property and the previous owners. Which of the following is not a key legal valuation detail? Not a key legal valuation detail. Yes, what should be the correct answer? Obviously, advocate's opinion is important. Valuer's opinion is also important. Whether it is an encumbered property or unencumbered is also important. But historical significance of the property and the previous owners not important. Right? So the correct answer will be D. What is the typical duration of a repayment holiday moratorium for a home loan? Up to 18 months after the first disbursement or 2 months after completion of the construction, whichever falls first. A maximum holiday period of 3 months for the purchase of land with building or flat, 6 months after the purchase of the property, or the entire duration of the construction phase. The typical duration of moratorium holiday period, repayment holiday. Is it 1 and 2, 2 and 4, 1 and 3, or 2, 3 and 4? It is correct. It is A. Right? Very simple question. Right? Okay. What does the check-off facility in home loan repayment entail? The check-off facility. No, this question is not there. Forget it. Yes. Which of the following is not an essential requirement for creating a mortgage by deposit of title deeds? There must be a debt existing or future. The documents deposit of document of title to immovable property in one of the notified towns. Intent to create a security for the debt and obtaining a letter of intent. Mortgagee's right to sell the property without court's permission. Which of the following is not an essential requirement for creating a mortgage by deposit of title deeds? So what happens? The mortgager delivers the original title deeds to the mortgagee in one of the notified towns of the state government. Yes, so the correct answer is D. If there's a default, the bank can sell the mortgage property but with court permission only. Without obtaining court decree, it is not allowed. Who can access and inspect the records which are maintained by SARSAI? Only government officials and authorized bank personnel. Any person upon the payment of the prescribed fees, exclusive to the parties involved in the registered transactions, financial analysts and market researchers, who can check and inspect the records maintained by SARSAI, the records that are maintained by SARSAI. What should be the correct answer? Yes, any person. Any person upon the payment of the prescribed fee can check the records which are maintained by SARSAI. Yes. What type of property is excluded from the provisions of the SARFAESI Act under Section 31? Urban residential property, security interest created in agricultural land, commercial office space, or personal vehicles. Which type of property is excluded from the provisions of the SARFAESI Act? So what is the SARFAESI Act? Bank can sell the mortgage property without court intervention in the case of default when the loan become NPA without court intervention, where the loan amount is more than 20 lakh or consortium 60%, all of those points were there. The condition is that if the security interest is created in agricultural land, then the bank cannot use their SARFAESI powers. Okay, so security interest created in agricultural land not eligible. Under a mortgage by the way of conditional sale, Which of the following statements are true? The sale becomes void on repayment of the mortgage money. The mortgagee can look to other properties of the mortgager for repayment. The sale shall become absolute upon the non-payment and court decree in favor of the mortgagee. Bankers prefer this type of mortgage due to its simplicity. Which of the following statements are true about mortgage by conditional sale? Mortgage by conditional sale. So, what is a conditional sale? The mortgager sells the property to the mortgagee on a condition that if the default happens, sale will become absolute. If the repayment is done, sale will become void, right? So the sale will become void on repayment. The mortgagee cannot look to the other properties of the mortgager for prepayment. The sale will become absolute upon non-payment, and the bankers they do not prefer this type of mortgage for the very reason that the mortgagee cannot look to other properties. So the correct answer will be A. 1 and 3 only. 1 and 3 only. Which statements are true about the features of a simple mortgage? The mortgagee has no power to sell the property without the intervention of the court. The mortgagee is entitled to the payments out of rents and produce of the mortgage property. The mortgagee is not put in possession of the property. Registration is mandatory if the principal amount secured is rupees 100 and above. Which of the following statements are true about a simple mortgage? So, what is a simple mortgage? The mortgager, the borrower, delivers. Without delivering the possession, they only transfer the interest. So, without delivering possession to the mortgagee, binds themselves personally to pay the mortgage money. And if they fail, then the mortgagee has the right to cause the property to be sold in the market and apply the proceeds for the payment of the dues. So the mortgagee cannot sell it without court intervention. The mortgagee is not entitled to the payment out of rent and produce. The mortgagee is not put in possession. True. The registration is mandatory if the principal amount is 100 and above. Options are incorrect. It should be 3 and 4. 3 and 4. No, okay, 1 is also correct. 1, 3 and 4. Right? The mortgagee has no power to sell without the intervention of the court. True. Right? So D is correct. They can get the property sold, but only after obtaining a court decree. Without the intervention of the court, it is not allowed. So 1, 3 and 4. Under the Section 80C of the Income Tax Act, in the context of home loan, which of the following is or are eligible for tax deduction? Repayment of the principal amount, payment of the registration fees and stamp duty, payment of the home loan interest, prepayment penalty on the home loan. Under section 80C, what can be claimed as a deduction? If you quickly answer these, then we will end the session in half an hour. All right? Yes, the correct answer is C, 1 and 2. Principal amount, registration fees and stamp duty. Which conditions must be satisfied to claim the deduction under section 80C for principal repayment of home loan? Property must be self-occupied. Construction of the property must be complete. Property should not be sold within 5 years of the possession. Deduction is available only after receiving a completion certificate. Yes, what should be correct? What should be the correct answer? What should be the correct answer? The correct answer will be D. The correct answer will be D. Right? Construction must be complete. If it is sold within 5 years of possession, then it cannot be claimed. and only after receiving the completion certificate we can claim the deductions. Okay. Under section 80 EE, which conditions are necessary for claiming deduction for the first time home buyers? Loan should be sanctioned within the financial year. Value of the property should be less than 50 lakh rupees. Home loan amount should not exceed 35 lakh rupees. Property must be self occupied. Yes. Which conditions must be satisfied to claim the deduction under section 80C for principal repayment? Under section 80C. Section 80C or section, wait, 80 double E, right? We are talking about 80 double E, yes. Yes, the correct answer is A, 1, 2, and 3. Okay. How is Section 80EE applicable in case of joint property ownership? Deduction is applicable on a per property basis. Deduction is applicable on a per person basis. Only one of the joint owners can claim the deduction. Joint owners cannot claim deduction if they are staying in the rented accommodation. What should be the correct answer here? In case of joint property ownership, how does section 80EE applies? Yes, it is on a per person basis. So 50,000 can be claimed by both the joint owners, right? Both the joint owners. Correct. In the case of a let out property, how is the deduction for the interest on borrowed capital under section 24 be treated? It is limited to 2 lakhs. It is limited to 30,000. There's no upper limit on the deduction amount. It cannot be claimed for a let out property. Yes. So if it is a let out property, rented or deemed to be rented, then what is the maximum limit for tax deduction? Correct. There is no maximum limit for tax deduction prescribed, and the taxpayer can take the deduction on the interest on home loan, complete deduction, right? The taxpayer can take the deduction on the whole interest amount. So the correct answer will be C. There is no prescribed limit. In the case of a joint home loan, which of the following statements are correct? Tax benefits are divided among the owners in proportion to their ownership share. Each co-applicant can claim a maximum rebate of 1.50 lakh for the principal repayment under Section 80C. Each co-applicant can claim the tax benefits. The property must be in joint names of the borrowers. Which of the following statements are correct for a joint home loan? For a joint home loan. Very simple question, right? Yes. Both the co-applicants can individually claim the tax benefit. Regarding the computation of the actual rent for a property, which of the following statements are true? Actual rent is the rent for which the property is let out during the year. Vacancy period must be deducted from the actual rent. Unrealized rent must be deducted if certain conditions are met. Actual rent calculation is based on the fair market value of the property. Yes, actual rent means actually the property was given out on rent. True. So which of the following statements will be correct? Which of the following statements will be correct? First statement is true, right? Actual rent is the rent for which the property is let out. Second statement is incorrect. Why? The vacancy period should not be deducted except for exceptional situation when there is unrealized rent. Unrealized rent means the owner of the house has taken all the steps to recover the rent from the tenant. The tenant is not available. The tenant is not going to repay it, is sure. Then the unrealized rent should be deducted. Otherwise, not. No, the correct answer should be C. 1 and 3 only. 1 and 3 only. Okay. Which statements are true regarding the tax deductions for the interest on loans against commercial property or personal needs? Interest can be fully claimed as a deduction from income from rent, business, profession. Principal repayment benefit is available in such cases. Interest on the unpaid interest is deductible. Deductions apply to individuals, HUS, partnership firms, companies, and other persons as well. Loans which are taken for personal use by individuals. Deductions are available only for individuals and HUF, but when on the loan is for the residential property. However, the loan is taken on the commercial property, securities commercial property, then what will happen? The deductions are applicable to the individuals, HUFs, and partnership firm, companies, and other persons as well. Okay? Interest can be fully claimed from the rent business profession. However, principal repayment is not available, and interest on unpaid interest is not deductible. Are you guys tired? I'm not getting your answers. If you stay for just half an hour more, we will end the session. Okay. How is the gross annual value of a let out property determined? Based on the reasonable expected rent or the actual rent, whichever is lower. Based on the reasonable expected rent or the actual rent, whichever is higher. Based on the municipal value of the property. Based solely on the actual rent received. So, how do we calculate the gross annual value of a let out property? Yes, it is based on the reasonable expected rent or the actual rent, whichever is higher. Whichever is higher. Right? So, how do we calculate it? The actual rent multiplied by 12 or the reasonable rent multiplied by 12. Whichever of the two is higher will be the gross annual value. Who is eligible to claim deductions under Section 80EE? Only individual taxpayers purchasing property singly, individual taxpayers purchasing property either singly or jointly, corporate entities purchasing the residential property, individuals renting the property that they own. Which of the following will be correct? Eligibility under Section 80EE is yes. Either singly or jointly, individual taxpayers are eligible. They are eligible to claim the benefit. Okay. An NRI can claim tax exemption on the home loan repayment in India only if they have a PAN card, they earn taxable income in India, they hold an OCI card, or they have a joint loan with a resident Indian. When can a non-resident Indian claim tax deductions? OCI is the Overseas Citizenship of India, right? Yes. Only if they earn taxable income in India. If their only source of income is abroad, then they're not taxable and they cannot claim the deduction. Which of the following prerequisites for claiming the tax benefits on a joint home loan? The property must be jointly owned and registered in the joint names. The loan must be sanctioned by a nationalized bank. The repayment must be made from a joint account. The ownership share must be explicitly stated. Yes, what should be the correct answer here? What should be the correct answer here? Which of the following are the prerequisites for claiming benefits in a joint home loan? The property must be jointly owned. Yes. The repayment can be done without a joint account as well. The ownership should be explicitly shared. Okay. According to the ownership, whatever loan they are paying, they will get the benefit. What is the key characteristic of a mortgage advice profession in India? It is heavily regulated by the government. There is a strict code of conduct mandated by law. There are no entry barriers to the profession. Mandatory licensing is required for all the practitioners. So, how is the mortgage advice profession carried out in India? How is it carried out in India? It is carried out without any rules and regulations. There are no entry barriers. What does the concept of time value of money imply? A rupee received in the future is worth more than a rupee received today. A rupee received today is worth more than a rupee received in the future. The value of money remains constant over time. Investing money today will yield no additional value in the future. Yes. So when we talk about the time value of money, we take into consideration inflation. So a rupee received today is worth more than a rupee received tomorrow in the future. How does the frequency of compounding affect the final principle of an investment? Higher frequency of compounding leads to lower final principal. Annual compounding results in the highest final principal. Increasing the compounding frequency increases the final principal. The frequency of compounding has no impact on the final principal. So, more the frequency of compounding increases the final principal. Yes. Increasing the compounding frequency increases the final principal. All right. Using the rule of 72, how many years will it take for an investment to double at an annual interest rate of 6%? How do we use the rule of 72? There are three rules: 72, 115, 144. How do we use it? How many years will it take for an investment to double? If we use the rule of 72, so simply 72 divided by 6, we have 12 years. Correct. 12 years. What is the effect of discounting on the future cash flows? It increases the future value of cash flows. It calculates the future value of current investments. It determines the present value of the future cash flows. It has no effect on the value of the future cash flow. So, what is the effect of discounting? What is the effect of discounting on the future value of an investment, on the future cash flows? Yes, it determines the present value, right? Compounding determines the future value, discounting determines the present value. According to the rule of 115, how long will it take for an investment earning 5% interest per annum to triple in its value? For any investment to become three times, how long will it take according at the rate of interest of 5%? At the rate of interest of 5%. So simply divide 115 by 5. You will have, no, you will have 23 years. A. Yes, 23 years will be correct. Okay. How does the interest rate affect the future value of an investment? Higher interest rates lead to a lower future value. The future value is independent of the interest rate. Higher interest rate result in a higher future value. Interest rate only affects the future value for the short-term investments. How does the interest rate impact the future value? What should be the correct answer? Higher interest rate results in a higher future value. Okay. Which of the following are the types of annuities? Very simple. Ordinary annuity, annuity due, deferred annuity, variable annuity. Which type of annuities exist? 1 and 2, 2 and 4, 1 and 3, or 2, 3 and 4? Which type of annuities exist? We have ordinary annuity and annuity due. Ordinary annuity at the end, ordinary and annuity due at the beginning of the period. At the beginning of the period. How does the future value of an annuity due differ from the ordinary annuity? I already told you. Payments for the annuity due are made at the end of each period. Each payment in the annuity due is invested for a longer period. An annuity due has a higher frequency value than an ordinary annuity for the same terms. An annuity due is used exclusively for loans. Yes, how does the future value of an annuity due differ from ordinary annuity? The payment of the ordinary annuity are made at the end of each period. In the annuity due, it is made at the beginning. Each payment in annuity due is invested for a longer period. That is why we multiply it by additional 1 plus R. Annuity due has a higher future value than the ordinary annuity. Yes, what should be the correct answer? What should be the correct answer? The correct answer should be C. 2 and 3 only. It is not exclusively for loans. Even when I'm making investment somewhere and I want to calculate the future value of the annuity due, I can use the formula. Okay, so C. What is the future value of an annuity of 10,000 rupees per year for 6 years at an interest rate of 11%? Yes, calculate this value for me, everyone. How do you calculate the future value? Let me once again tell you the formula. Present value 1 plus r raised to power n. No, annuity, right? Divided by r. Can you calculate it for me? Tell me the correct answer. Everyone. Tell me the correct answer. Because you need to calculate annuity, that is why we are using this formula. Otherwise, the simple one would have been used. So, 10,000 rupees multiplied by uh, 1.11 raised to power 6 divided by 0.11, right? Let me also do it. 1.11, 1 plus r, yes. Minus 1 is also there, right? You need to add minus 1 also. Minus 1, minus 1. Okay. So multiply 1, 2, 3, 4, 5, 0.87, 0.8, 0.87 divide 0.87 divided by 0.11. It is 7.90, 7.90909. It is repeating. Multiplied by 10,000. It should be somewhere around 79,090. So A should be the correct answer. Are you getting this calculation? Everyone is getting A? Somewhere around 79,000? Yes, 79,000. If you want, I can show you the calculation once again. If my calculator is visible, if my calculator is visible. So in the numerator, first you need to calculate 1 plus r raised to power n. So 1 plus r is 1.11. So 1.11. I will press the multiplication button once. And then 6 years is given. So I will press the is equal to button 5 times. So 1, 2, 3, 4, 5. It is 0.87. Then you need to subtract 1 from it. So 0.87, right? 0.87 divided by denominator 0.11. 0.11. It is given me 7.90, somewhere 7.90. multiply it with the present value. Okay, that will be the correct answer. Hmm. In the case of compulsory acquisition of an asset, how is it treated for capital gains tax purposes? It is exempted from the capital gains tax. It is considered as a transfer and can lead to capital gains. It is not considered as a transfer for the capital gains purposes. Only the compensation received is taxable. Compulsory acquisition done by the government is considered as a transfer and it can lead to capital gain. Which section do you remember? Do you remember the section that allows to claim the deduction on capital gain in case of compulsory acquisition? Do you remember the section? Who can tell me the section? Which section is it? The gain arising due to the transfer of land or building. 54 is obviously 54. Under which section of 54? 54 is what? Residential house property is sold and the proceeds are used to purchase another residential house property. That is 54. Specifically, I am talking about compulsory acquisition. Now you're just making the guesses, right? It is section 54D, right? 54D. Okay? 54D. 54B is agricultural land. Okay, 54D says that if the government compulsorily acquires a industrial land or a building for industrial purpose, which was used for industrial purpose, and I use those whatever I get to buy another land or building for industrial purpose, I can claim the benefit. That is section 54D. 54B is for the agricultural land, and 54 is the residential property. Which of the following assets is the period of holding considered 24 months for it to be a long-term capital asset? Listed shares on a recognized stock exchange in India, unlisted shares in a company, units of equity-oriented mutual fund, immovable property. For which of the following assets the period of holding is considered to be 24 months? To be determined as short term or long term. 24 months. Yes, what should be the correct answer? Listed shares in a recognized stock exchange 12 months, right? Unlisted shares 24 months. Unit of equity oriented mutual fund 12 months. Immovable property is now considered 24 months. Earlier it was 36 months. Now it has been reduced to 24 months. Correct. A person invests 10,000 rupees for 3 years at 10% compound interest. What is the future value? You need to calculate the future value, not annuity. You just need to calculate the future value. You are answering for the previous question. D was the correct. B and D both same options. Answer for this one. Calculate the future value. Future value is equal to present value multiplied by 1 plus r raised to power n, because it is not stating that it is annuity or annuity due. So we'll be using this formula simply, right? So 10,000 rupees multiplied by 1 plus 1 0 raised to power 3, right? So 1.10, 1.10 multiplication 1 2, 1.33, right? 1.33 multiplied by 10,000, 13310, 13310. Correct. The correct answer is B. Very simple. If the question is stating that you need to calculate annuity, then you will use the annuity formula. Otherwise, you will simply use the time value of money formula. Okay. Mr. A sells debt mutual funds after 2 years for 5 lakh rupees. Purchase cost was 4 lakh rupees. What is the short term capital gain and the tax payable, assuming 30% slab rate? All you need to do is calculate the short term capital gain and then multiply it by the tax slab. Simple, very simple. What should be the correct answer? Yes, 1 lakh gain, 30,000 tax. Correct. Very simple question. Hmm. A sells a plot of land in the financial year 2025-26 for 40 lakh rupees. Hmm. It was purchased in the financial year 2005-6 for 10 lakh rupees. What is the index cost of acquisition? I will not tell you the formula. We have already done questions on the index cost of acquisition. You calculate it and let me know. You calculate the index cost of acquisition and let me know the correct answer. What is the index cost of acquisition? D. That was quick. So how do we calculate it? Simply the cost of acquisition multiplied by CII of the year of transfer divided by the CII of the year of acquisition. So 40 lakh rupees multiplied by the year of transfer was what? 376 divided by 117. Yes, calculated. Multiplied by 376 divided by 117. Wait, I'm not getting this answer. Why? Okay, the acquisition price is 10 lakh, not 40 lakh, 10 lakh, right? So I was using the wrong value. Multiplied by 376 and yes, divided by 117. Now I have the correct answer, 32 lakh 13,675. Sorry, I used the wrong value, not the consideration price, but the acquisition price was to be used. It was purchased at 10 lakh rupees. Okay, yes, D is the correct answer. Okay. Mr. B sells a residential property in the financial year 2025-26 for 60 lakh rupees. It was acquired in the financial year 10-11 for 25 lakh rupees. What is the index cost of acquisition? CII for both the years is given. Okay. So the price of acquisition multiplied by the CII of which year? Of the year of transfer divided by the CII of the year of the acquisition. Yes, this is how we do it. So it was acquired at 25 lakh rupees multiplied by the year of transfer is 376 divided by the year of acquisition is 167. So 56 lakhs somewhere 2874. 56,13,772. All right, so this will give you the correct answer, whatever is the correct answer. Even I am getting some other value. Okay, so 56 lakh 28,742. That is what I got. Okay, all right. Mr. C sells listed equity shares in the financial year 2025-26 for 3 lakh rupees. He bought them in the financial year 2023-24 for 2 lakh rupees. What is the capital gain and its nature? What is the capital gain and its nature? Whether it is a short term capital gain or a long term capital gain, or is it exempt, or the tax, or is it taxable at 20%? What should be the correct answer? Yes. So they purchased the listed equity shares in 2025, sold in 2025-26, purchased in 2023-24. Holding period is 2 years, correct. But more than 12 months, so it is considered as a long-term capital gain, correct. In case of listed equity shares, we do not consider 24 months, we consider 12 months. Mr. D sells a commercial property in the financial year 2025-26. It was acquired in 2001 to 1 crore 20 lakh, right? 1 crores and 20 lakh acquisition. Improvement was done in the financial year 2008-9 with 5 lakh rupees. Calculate the total index cost. You need to calculate the total index cost. So first calculate the index cost of acquisition, then calculate the index cost of improvement, and then add it. So you will have the total index cost. You will have the total index cost, right? So let us calculate one by one. For the index cost of acquisition, it was acquired at 20 lakh rupees, right? Multiplied by the year of transfer. CII of the year of transfer is 376, divided by the year of acquisition is 100. This will give you the index cost of acquisition. Index cost of improvement. Improvement cost was 5 lakh rupees, multiplied by the year of transfer, divided by the year of improvement is 89137, right? Calculate it and let me know. Multiplied by 376 divided by 100. It is 75 lakh 20,000. 752. Okay. And improvement is 5 lakh multiplied by 376 divided by 137. So that is 13, right? 13. 13 lakh 72,000, somewhere there. Okay, near to option A. All right, so whatever is the answer, whatever is the answer. If you have to calculate the capital gain, simply the property was sold at 1 crores, it was purchased at 20 lakh. The difference between them is 80 lakhs, right? From that, subtract this total cost of indexation and you will have the capital gain. It is a long-term capital gain. Okay. Under which section can an exemption be claimed for the long-term capital gain arising from the transfer of residential house property? Capital gain exemption from the transfer of residential house property. Which section allows us this? Two, three questions more. Just two, three questions more. 54. Yes, section 54. 54B Chaitanya is about agricultural land. Here we are talking about the residential house property, right? When I sell or transfer a residential house property, use the capital gains investing in another residential house property, section 54. When I transfer a agricultural land, reinvesting it in another agricultural land, it is section 54B. 54F, if I'm talking about 54F, the long term capital gain, transfer of any capital asset other than residential house property, right? Other than residential house property to be invested in residential house property. And 54 EC talks about long term capital gain other than house, any long term capital gain, right? Any capital asset to be invested in the bonds of NHAI or REC. No, not B, right? So the correct answer will be 54. I hope it is clear. Agricultural land. Yes. Which section allows for exemption of long-term capital gain for investments in the startups? Long-term capital gain if I invest in a startup company. Which section allows it? Section 54 double E, 54 GB, 54F or section 54 GA? What should be the correct answer? It is, you are saying B. B is what? B is GB. Section 54 GB. Yes, correct. Long-term capital gain arising on the transfer of a residential house property utilized utilized for the subscription of the equity shares of an eligible company, eligible to be included in the definition of a startup, right? Correct, GB. If we talk about section 80 double E, it is to for the government to finance in the startups, right? Startups which are financed by the government. 54F we have already discussed. Any capital asset other than residential house property to be invested in residential house property. And GA is the industrial undertaking. Transfer of land, building, plant, machinery from an urban area to a special economic zone. All right, so the correct answer should be B, not A, B. Okay, what is the condition for claiming exemption under section 54F? The gain must arise from the transfer of agricultural land. The gain must arise from the transfer of any capital asset other than residential house property. Investment must be made in the bonds of NHAI or REC. The transfer must be of industrial property only. Section 54F. Section 54F. Correct. Right? 54F will allow me to claim benefits when the long-term capital gain arising on the transfer of capital asset other than a residential house property, the net sale consideration is to be reinvested in the purchase or construction of a residential house property in India. Last question for today. What should a taxpayer do if the capital gain from the sale of a house is not fully utilized in purchasing or constructing a new house by the return filing due date? What should the taxpayer do? What should the taxpayer do? They will deposit the unutilized amount in the capital gains account scheme. Correct. All right. So now we are going to end today's session. We could complete only module E today because we had to revise the theoretical portion also. Now tomorrow we'll be doing only the questions, MCQs and numericals for module A, B and module D. And case studies from module C also we will cover. Tomorrow also you'll be having your class from 7 p.m. And we'll be practicing only the MCQs, only the questions. All right. I think 4 hours is enough for one go. If you still want to continue, I'm pretty sure on the Hindi medium channel, the class would be going on. Rajiv sir would be taking the classes. If you want, you can join there. Okay. Otherwise, we will be doing the questions tomorrow. All right. We'll be doing the questions tomorrow covering remaining modules. So before you leave, please like the session and revise revise these topics, revise all the notes that you have. I will upload the PDF for your revision and we'll be meeting tomorrow now. All right? Now take care, take rest because it is also important. You need to wake up tomorrow and go for your offices. So sleep now and we will meet tomorrow. We are doing numericals, right? We have practiced numericals from module E. Remaining numericals from module A, we will do it tomorrow. Okay? Manohar, we'll do it tomorrow. The remaining numericals, module E numericals already done. Do not worry about numericals. Maximum numericals will be of 10-15 marks. Maximum. The remaining 80-85 marks are your theory, the concepts. If you understand the concepts, you will easily solve the numericals. You can easily get 60 plus only by studying the theory also. Okay, so let us end the session now and we will meet tomorrow. So good night, take care and all the best. Thank you everyone for attending the session. Please like and share the video.